Hello. Hello.
Hi, Samir. Good afternoon.
Hi.
This is Aditya.
Yeah, I just want to. Can you give me the hosting things? I just want to check that my this thing is working.
Yes, yes, of course. Yeah, made you the co-host.
Yeah. Okay. Well, yeah. Perfect. It'll come.
So it's 2:56. We'll be starting something like 3:3, 3:4 or so. So I'll just
Yeah.
get.
No problem. So should I share now and let that cover page be there?
Yeah, yeah, please do that. And just a quick thing.
Yeah.
So this the speakers are using the Zoom. All other attendees, they are logging in through a virtual event platform. So they will be
Acha, so
watching
that
us
means
live.
what?
I'm saying the on the Zoom, it will just be you and me.
Acha.
All the attendees are watching it live, but they are watching it through a event virtual event platform. So
Okay.
they'll be sending us questions separately, and I'll be reading out to you at the end of the session.
Okay.
So that's how we'll go.
Oh, got it. Got it. No problem. So now you can see the cover page.
Yes, yes, we can.
Okay. Perfect. Okay. So we'll wait. I'm
Yeah,
okay.
let's just get started. Another 5 7 minutes. Thank you.
No problem.
we'll just wait for a minute or two for people to log in.
How come my thing is coming from there? I thought I'm connected through my headphones. Okay.
Are you in Singapore currently?
Yes.
Okay. How are things? How's the situation there?
Actually, situation is very good, but from yesterday they went back one level. So till yesterday, it was more open than it is from Saturday, which means now they've closed the gyms, and now only 5 people can meet. Previously, 8 could meet, and office 75% could go, and now only 50%. And the reason for that is that they had 9 cases.
Okay.
And day before they had 15 cases, and out of these total cases, and before that it was 0 for like 2-3 months, and 5 of those cases have Indian strain.
Oh.
And also on just this and maybe fear, the quarantine was 14 days for everybody coming in from outside. Now, other than 4-5 countries, it is 21 days in a hotel for everybody, not just India. India, even US, UK, everything 21 days. And that has been announced yesterday, and I think goes into effect on Friday night or something.
Super. I mean, I know it sounds ironical, but you just mentioned 9 cases and 15 cases, and I
crazy.
We have
one building in Delhi, in our house where my mother's living. She's okay, but there were 5 cases in the house.
I was going to say in our wings and our societies we have more cases. So, but that's what makes Singapore so.
Yeah, it's very efficient, and so fast they react because it is in that way purely scientific. There is, I mean, you can do whatever power you have. Let us say you want power and you want money, you can have it, but rest of it you should do scientifically or professionally. In India, the ego comes in and you hire these third raters like our health minister and our foreign minister. I mean, they are both a complete disgrace to the nation.
Okay, so I think time for us to get started. Audience, I hope you've joined in for this already now for this very, very exciting session. We don't want to keep holding on to those who already joined in because everyone is very, very eager to listen to our next speaker, Mr. Sameer Arora. And before I start, let me quickly introduce him to all of you. Of course, someone like Sameer doesn't need any introduction, but for the sake of formality, let me just quickly tell you all that Sameer is the main founder and fund manager at Helios Capital. From 1998 to 2003, he was the head of Asian Emerging Markets at Alliance Capital Management in Singapore. From 1993 to August 2003, Sameer was the Chief Investment Officer of Alliance Capital's Indian mutual fund business, and along with managing Alliance Capital's Asian Emerging Markets mandates, managed all of Alliance Capital's India dedicated equity funds. In 1993, Sameer relocated to Mumbai from New York as Alliance Capital's first employee in India to help start its Indian mutual fund business. He also managed ACM India Liberalization Fund, an India dedicated offshore fund from its inception in 1993 till August 2003. Prior to 1993, he worked with Alliance Capital in New York as a research analyst. Sameer has received his undergraduate degree in engineering from the Indian Institute of Technology, New Delhi, and his MBA from the Indian Institute of Management, Calcutta, in 1985, where he was a gold medalist. He also received a master's degree in finance from the Wharton School of University of Pennsylvania in 1992 and was the recipient of the Dean Scholarship for Distinguished Merit while at Wharton. So, while designing this entire event and the agenda, it was a dear friend, Devi Prasad, who's earlier with ICC Prudential AMC and now with Helios Capital, who suggested Sameer's name, and we could honestly not really could have asked for more. I mean, the moment he said, Sameer would be happy to participate, and I'm like, this is going to be one cracker of a session. So Sameer, thank you so much for joining in. The first time in an AIWMI event. Just to give you a brief background, AIWMI was set up in 2013. Our objective was to enhance professional standards in the financial industry through financial education programs. And when I say financial education, it meant a more of a 360-degree approach. So we offer certifications, we conduct events, we have awards and various other advocacy and thought leadership initiatives to bring the industry together and hopefully contribute to the betterment of the industry.
Very
So,
good.
so Alternative Investment Conference was started in 2013 when AI was very new in India, and this is the 8th year, and we are so privileged to have you with us this year, and looking forward to have you in person maybe next year.
Yeah, maybe next year. Let's hope these things are sort out quickly, because the good thing or the bad thing is that in this environment, to talk about how you should make money itself looks bad in some sense. But the good thing is that I can do it through Zoom,
Yeah.
and that makes it very convenient for me to participate from here.
No, I'm
And
sure.
therefore, it was much easier. So quickly, let me go to big picture. I will start with the let's get the elephant out of the way, whether you should be in equities or not, and then I'll come to how to construct. Because for me, I've been quite good in terms of stock returns and all, but one part of that has been, for anybody who's done well, whether you look at Rakesh Jhunjhunwala or anybody else, is because they believed in the concept of equity. If you believe that, you will not be shaken out of the market in bad times, and you will remember that you should add, average, whatever. But for that, you must first absorb the thing that equity itself is better than anything else that you can do in financial terms in with the alternatives that normally people have. So this is for the period of which for which I have been a fund manager. We started with the first fund in 1995, which was a balanced fund. But in 96, we had our first equity fund in the Alliance days. And so just to tell you, this is the return of the Indian market over this period. This is till March 31 of 2021, so very recent. And if you compare it to gold, for example, which is an easier thing to find, at least formal performance for, because real estate would be difficult to find in a neat form, which I can present to you, but it has significantly outperformed gold over this period in rupee terms. It has clearly outperformed fixed income investments over this period. But if you just quickly, one slide only on me, and then we'll go. If you look at my performance, which I'll tell you how we got it or what is the philosophy, but if you just look at the Alliance performance, plug in the Helios performance, the only thing is convert Helios into rupees. And actually, Helios fund is not even a long only fund, it's a long short fund. And over the same period in which the market is up 221 times, the performance of a fund, or basically two funds put back to back, is 287 times. I'll cross this, but I don't want to overstress on this, and then I'll keep talking about this. So it is up 287 times, but this is after paying some 2% per annum, let's say, rack rate fee over these 24 years. Therefore, what I want to show you is that with the market up 20 times, even a diversified portfolio of 30, 35 stocks can go up nearly 400 times, as it has done for me pre any fee. But just to show how it can, this much can be extracted from the market, where actually the market does not have that many stocks that are up 400, 500 times. And that is the whole story, and I'll come to it. But before that, when coming to the performance of equity over this period, people may say, oh, but right now there is COVID and there is lockdown fears, or lockdown has happened in some places, or slow this thing. But any of these events that you see, which we have seen from 1996, for the same 25-year period, any of them were significant at that time, worth at least a 10-15% drop in the market in those times. If you see, actually there was a 17% fall in a day in 2004. We have had Asian crisis, Russian crisis, global crisis, financial crisis. We've had bursting of the technology bubble, 9/11, November 26th, which by the way happens to be my birthday. And we've had billionaires getting arrested. We've had governments fall. The government lasted 13 days, which was Atal Bihari Vajpayee's government. We've had droughts, we've had wars, we've had this thing, and still the market goes up. This is not true only of India. This has nothing to do with the fact that India is a great country. It is to do with equity markets. I have written an article recently for Outlook magazine, which will come in their next issue. The same things happen in the US, in all countries, that the equity markets over time give much higher returns than others. And this is to be absorbed and accepted first before you say how to choose stocks, because it's part of this thing that I will change my shares, I will change my thing, I may sit on 10% cash, but I will not walk out of the equity market. In fact, I should average in those days, because if this is the return when there was a point-to-point return, that means you're just counting as if you invested in March 1996 and this is March 2021. But in between, whenever the markets fell 10%, 20%, 30%, if you had averaged, then your returns just arithmetically would be much higher than having just bought at one point and waiting for the other end. If you look at it another angle before I come to the actual philosophy and how to construct a portfolio, is look at it from a foreigner point of view who has many choices. And look at how foreigners have preferred India. This data is only since 2017, but broadly they have preferred India for a long, long time. But if you look at 2017 to now, if you can see in any of these years, say, let's look at 2020, which was last year. So India got FII flows of 23 billion, while the rest of emerging Asia lost basically $55 billion. So that the total is minus 32. That includes a plus 23 for India. You can look at 18, where basically totally 39 billion went out, but only 4 from India. And then in 17, which had 22 billion of inflows, 8 came to India. This does not include China, which itself is a very big number. But other than China, which for some reason is not easily captured in these data, whichever we find, it has always been like that. So now let's go to the actual part. How did this happen? Why do we like India? Why do I like equities? And more than that, that part is on how did I, because who knows, but this is how I think my philosophy developed over time, and it seems to have worked. So first thing which I learned early on in life is that because I read a lot, I found quickly that on every topic you can find a book. This is almost like Twitter, where you say anything and somebody will find a counterpoint. So for example, I tweeted today that Pfizer is a good vaccine, but then somebody will be able to find an article somewhere which says that Pfizer vaccine led to 2 deaths and 3 people having problems. So anything you can find a opposite view. And one part of investing is to sit back and say, is there an alternative view? Because you may read this book, which says the little book of value investing. And then it says Chris Brown is one of the best value investors in the world, said Mr. Barton Biggs. And you will read this book and say, I read this book on value investing, therefore I will do value investing all my life. And then you will find this book. This book is written by the same publisher, as you can see from the format called Little Book. And it says a proven market beating formula for growth investing. And then there'll be a quote on the top that Navalier is an icon among growth investors. You will read this book, which says Benjamin Graham on value investing. And one of the luckiest events in my life was when I met Ben Graham, says Warren Buffett. And you will read this book and say, therefore, I have to do value investing. And you start writing essays, as some of our guys do. And then you'll find the same format, same style, Benjamin Graham and the Power of Growth Stocks. You will find a book which says that crowds are mad, and that extraordinary popular delusions and the madness of crowds talks about the bubble in the olden days when the tulip bubbles and all these bubbles happened. And then you will find that in the world's 3rd or 4th largest company, Google, has basically been created on the concept of the wisdom of crowds. The whole point, as I will explain again and again, is that don't go by these one-liners for yourself and for your fund manager to tell you that there is a simple formula. There is no formula which says that beaten up stocks will do well, and there is no formula that quality stocks will do well. There is no that kind of a formula. I'll explain what, according to us, is the little bit of a formula. But let's look at these obvious things which we are told in this market, in the fund management industry by fund managers, and people themselves start believing. It's not that they are telling a story because they have read one side of the story or because they don't question things enough. They come up with these simple ones. This one is very, very common across the industry, that we buy stocks with high conviction, that we have 50-point checklist. We check those things and only then we buy a stock. And according to me, the simplest thing is that you don't buy things where you have high conviction. You only do things where you have low conviction. And the logic for that is as follows. Let us say you want to buy a house in Delhi, and somebody says, no, I've got a good house, big house for you in Faridabad or in Meerut. You say not interested. You are highly convinced that you don't want that. But if somebody says, okay, in Delhi, do you want GK or do you want Defense Colony? They will say, show me both and I will decide. You have no conviction. You will do analysis, you will do things, but the rejection will be down outright. Warren Buffett says, I don't buy tech stocks. Although now he's even bought Apple. But let's say he says, I don't buy technology stocks. That is his highest conviction. He does not say, I will first look at 50 years of annual reports, and then I will go and meet the director and board member and CEO, and I will discuss with my friend Bill Gates. He says, I am not interested, because he's highly convinced that it is not for him. These things are not just academic. We have to build it into our thinking on investments, which I'll come to, on what we do. But the point is that what you buy, you have less conviction in than the things you don't do or don't buy, or girls you don't marry or boys you don't marry. You're more convinced about them because that is why you dropped them and moved on to the next guy. But where you wanted to marry, you said, now let me do more investigation. Let me meet her parents. Let me meet her a third time. Let me go out with her to see whether we gel. But for the ones that didn't work, you said not interested and moved on. So you don't buy things with high conviction. You reject things with high conviction, and you buy things where you slowly get convinced. And that means that if you say that I have a 50-point checklist before I buy a stock, nobody's ever asked that fund manager except me, that what happened when you had checked only 48 items. You were not convinced that you still had to check 2 more items. That means you just wanted to cross a little bit of a hump of conviction before you buy. And that is a big difference, as I'll explain later. The other thing which, say, Mr. Buffett says, and in India, all the followers and blind followers and copycats say, that we should own stocks for the long term. Other than the tax angle, which in India itself is very low, it makes no sense to say it. You may own a stock for a long time, as I have done with many banks, private sector banks and all, but you don't have to say it. It's very simple. Let us say you are choosing from 500 stocks. In this case, it says 3,000, but let's say there are 500 stocks and you want to buy 20 stocks. Now, 1 year later, all these 500 stocks, their prices have gone up and down. The fundamentals have gone up and down. How is it possible, logically, that next year you've ended up buying or owning the same stocks only because last year you had chosen them, when over the 20 stocks themselves and the 480 you did not buy, there were positive developments and negative developments. There were positive stock prices and negative stock prices, so that maybe something which was the 21st stock last year suddenly has fallen 30%, but nothing else has changed. And therefore, that is the better stock. So to say it like this, that a fund manager should say to a new investor coming into, say, his PMS, that these are the 20 stocks for you. Because last year when I started my PMS, I had found these stocks for those guys. And that day I had committed that I own stocks for the long run and I don't churn and I buy right and sit tight. Therefore, today when you are coming in, I will just buy you the stocks that I bought a year ago. So it is just unrealistic to think like this. It also shows how blindly in India we copy some of these things. So for example, Warren Buffett and all these guys said low churn. And they said low churn because they have very high capital gains taxes, particularly Buffett, because he operates in a company and therefore he has to pay 30-35% tax as if it was a normal income tax. like a normal income tax. In India, till 2 years ago, there was no capital gains tax if you had held the stock for 1 year. So there was no even a tax benefit to say that I have low churn, I don't rotate, I own them for long. It makes no sense. The only way it makes sense is that you are owning it, it continues to do well, you continue to own it. That does not make you a long-term investor. I have owned HDFC Bank for more than 25 years from its IPO day itself. But we never say that we have owned the stock as a long-term investor. The company delivers and we keep it. If the company was not to deliver, we are not going to give them 2 years' time saying we are long-term investors. So that is the way we look at it, because it is unrealistic for people coming at different times into a thing saying, no, but 3 years ago, this was my portfolio. For those guys who bought our fund at that time, and therefore the same stocks are appropriate today. Another thing quickly on this, which in India, I'll give you some example, but basically, again, this is Warren Buffett kind of argument that as if you get only 20 chances, he just used that as a number, that there are only 20 chances you get to buy stocks, or you should act or feel that you have only 20 chances so that you think before you buy any stock, which is fair. Obviously, you should think and research and analyze. But what did he himself do? So this is a paper which you can find on the net, written by 3 academics, these 3 fellows, John Hughes and whatever, and they analyzed 26 years of data for Warren Buffett or for Berkshire Hathaway. And these were, as you can imagine, his prime years in the 1980s and 90s when he really created the outperformance that he's still running with. And they found that his own median holding period was only 1 year. If you look at Rakesh Jhunjhunwala has made his entire wealth for maybe 10 stocks. And the rest are stocks which he has bought. Some he may have traded, and then they worked for him, and some didn't work for him, and they broke even. But in the end, he had Titan, and maybe he had Crisil, or he had Lupin, or he had some whatever. And from those 7, 8, 5 stocks, out of maybe 100 stocks that he bought, he created his wealth. It was not that he started by buying only 20 stocks, knowing that which stock will do how well. These are all theories told only in hindsight. The other one, which is an easy one to sell to the public, to investors, we have some guys today who argue as if this is some great formula they have found, is buy companies with good management. But nobody has ever told them that when will you know that the management is good. Let us say Kotak, which is a broker, becomes a bank in 2003. So at which point did you realize that as a banker, it has good management? If you said it on day one, then it's just theory because you don't know it has good management. If you say I waited for one crisis, one cyclical upturn, downturn, and then I realized that they know how to allocate capital and how they are disciplined and how they don't cheat shareholders, you have wasted 8, 10 years before you would buy that stock. The beauty is that all these guys in India and in the world maybe say how this company has created wealth and that company has created wealth because it has good management, except that you would not have known it has good management from that day because nobody knew that day whether Aditya Puri, who's just come from Citibank Malaysia, what was the claim to fame on that day that I am in Citibank Malaysia, but turned out to be a great management. So we have to figure out how to deal with these things, because it's easy to say that we will buy good management. In most cases, by the time you're clear that the management is good, maybe the CEO is retiring. So what is management? In a multinational company, is the parents' management being considered, or the CEO's management being considered, or why is it that in Nestle, when the new Indian CEO came, the company has started doing well? That means previously the management was not great because he was a Swiss guy who was not deeply interested in India, and maybe he took India as just a stepping stone as part of his global training and as he moves up the career path. Whereas for somebody, Indian guy who took it seriously and said that he wants to concentrate on India, and for him it was not just a posting as part of his international career. So what is management? And the second thing is, how will you separate the halo effect? Halo effect basically means that if a company is doing well, Everybody assumes that the stock is doing, that the management is good, which I will show you now. So this is an article in Fortune magazine in May 2000, in which the Fortune Cisco, this is from a book called The Halo Effect, this example. So Cisco was rated as the most admired company or whatever as per Fortune survey, and it was a bull market in technology. And they said, is John Chambers the world's best CEO? They run a tight shape, they're customer focused as much as you can see in anybody, and everybody flew coach. And then in 1 year, the stock price fell. And the same magazine, which had previously said this, and the price became 15, said, Cisco sales techniques have been irksome and have alienated customers. 1 year ago, they were saying, John Chambers is the most customer-focused human being you will ever meet. Acquisitions, forecasting, technology, all have failed Cisco because the stock price had fallen. Same thing you can see in India. Nobody ever tells you an example of a company that has a really bad stock price and people say it has excellent management. But look at it like this. We talk about fund managers trying to find good companies. Here I'll give you examples about people who spend 5 years only trying to find good companies as a full-time 24-hour job, you can say, and how was their success. So this is a book called In Search of Excellence, which came in the 80s. I read it in the 80s. And so it must have come in 70 something because of the date that I can see here. So these guys from McKinsey Partners, and they wrote a book called In Search of Excellence. And when the book came out, which was in 1980, from 1980, they looked at the stock price for the next 10 years. And out of the 31 excellent companies that had been identified in that book, 13 of them only outperformed the index. Then there was this book called Built to Last. This is a more current book in the late 90s, I think. Oh, yeah, it says 91. So this book, they found these are academics who wrote a whole book on companies which are built to last and blah, blah, blah. Of course, of the 16 companies they found, only 6 outperformed the index over the next 10 years. But please look at the companies that they found. These are not some fund manager who's doing 20 things and has just said this company is good. These guys' whole project, the whole book, the whole academics is on trying to find companies built to last. And they found Citi, which is nearly gone in the global crisis and even now gone. They found Ford, which is more or less, less than one gaming company in India's market cap maybe. They found Ford. They found GE. They found HP. They found IBM. They found Motorola. None of these companies basically exist. They exist, some of them, but they're like nobody is interested in them. And then these guys did another book called Good to Great. And look at the companies they found as good to great. They found Circuit City, which I think is nearly bankrupt. Fannie Mae is gone. They found Pitney Bowes, which is gone. They found Walgreens, which is gone more or less, just one of these retailers. They found Wells Fargo, which, as you know, has done miserably over the last 5-10 years. So the point is, even full-time guys couldn't find what is a good management. All these things we have to build into how to do things. It's not just to poke fun at others. The other one is that don't worry about valuations. If you're sure of growth, no problem. One day the growth itself will take care of the fact that you may have bought it high price. The normal answer will be, okay, if you paid 20% extra and therefore you're growing 20% per annum, so now you'll have 19 years of growth instead of 20 years of growth, and that's a great return. This is one of the most ridiculous things ever presented, as if you know that otherwise the company is growing for 20 years. If you saw the recent AGM of Berkshire, which was on this Saturday, Warren Buffett presented the top companies in the world in 1991 and then in 2021, and not a single company was repeated which was in the top in 1991, which also was there in 2021. But look at this study. So this is IBM versus Standard Oil, only compared for 53 years, not for 5 years and 2 years, but bloody 53 years. And over these 53 years, IBM grew its revenue 12% per annum and Standard Oil 8% per annum, and earnings per share 10.9% per annum. and 7.4%. So it's a massive difference. If you were to compound this for 53 years, where IBM is compounding at near 11% and Standard Oil at 7.5%, and you can imagine the curve. And if you don't want to do it, you can check on your phone or whatever. And then how much did IBM outperform Standard Oil over this period? It underperformed. After compounding at a 3-4% higher rate for 53 years, it still underperformed what happened to Standard Oil. And look at it in India. So Infosys in 2000 had a valuation of 95 times. And for the next 5 years, its earnings grew 44% per annum. There's not a single company today which is trading at 70, 80 multiple that anybody thinks is going to grow its earnings at 45% per annum. And the Infosys stock price went from 139 rupees to 141. Adjusted for the splits post that. So basically, Infosys did not move for 5 years while its earnings grew 45% per annum. And then the same Infosys, in another phase of its life, which is from 2013 to 19, grew its earnings only 10% per annum. But look at the stock price. It didn't do great wonders, but it massively outperformed that because the PE was 15 when the whole story started. So this idea that it doesn't matter, that there are only 10 companies in this country and all that, I will show you, all that makes no sense. But anyway, quickly, two more before we come to what is the way. So diversification is a protection against ignorance. If we know so much about these companies, if we are confident about these companies, why can't we buy more? Actually, this is Warren Buffett's line, and he has created, I think he has wasted so many investors' money with this line, because the fund manager can no longer be seen as saying that we are diversified, because the investor will say, but that means you are ignorant. You are not confident about what you do. And we say the following: A, that we don't know, we are ignorant till something unexpected happens. And what if you don't know you are ignorant and are concentrated, you will blow up, as it has happened for hundreds of people in the world. And now let's look at it differently. Let's say that there are 100 investors in India out of whatever, how many million investors, who are not ignorant. And therefore they are concentrated. Of course, in reality, there might be many more who think that they are not ignorant, but let's say that actually there are 100 investors who are not ignorant, and therefore they are legitimately concentrated. Now, unless you think that every one of them is going to buy Bajaj Finance and HDFC Bank, and so they will have identical portfolios, in which case it makes no sense. The reality is that these 100 investors will end up buying, even if there are 2-3 companies different and 7 companies are same, because they buy 10 companies each. That means broadly they are owning collectively some 150, 200 companies. Let us say 9 companies that they own are same as others, but one guy will have this, one guy will have that, one will have sugar, one will have metal, one will have bank. But all these 100 guys are not ignorant. So collectively they own some 200 companies. Now, if you go in and buy 35, 40 companies, what harm have you done? Anyway, all those companies, somebody else who is not ignorant is owning in a concentrated way. The reality is that somebody will do well and somebody will do badly. Because if all do well, that means the whole market is doing well. But realistically, some will do well and some will do badly. And the guys who do well will think that they are heroes, and people will give them extra this thing. But in the end, that is just luck. That is not a strategy. Because all cannot succeed in concentration. So it can't be the strategy which is good or bad. It is just that whoever found 5 good stocks and actually they were the best stocks, obviously he will do well. But there'll be some other guys who will find 5 bad stocks. So it's not the concentration that is the thing. It is okay if you find right stocks, I agree. But the reality from an investor point of view is that no investor has the courage or the guts to invest with only one concentrated fund manager. So in any case, the investor, if he buys 3 concentrated funds, he is not concentrated anymore. Therefore, this whole idea is illogical according to us. Quickly. Now let's talk about Buffett just for the sake of it, and then I'll quickly come. So this is my thing to say that how concentration has hurt Warren Buffett. So he bought Coca-Cola in 1988, and at that time it was one of his top holdings, and even now it is one of his top holdings. So we don't know exactly in which month of 1988 it was bought, but by December 1988 it was in his top holdings. So from that day to March 31, 2021, or maybe this is till December, let's see. Basically, the Coca-Cola stock is up 12.2% per annum, but Berkshire stock is up 14.4% per annum. Therefore, if he did not have Coke, his performance would be better because Coke has done worse than Berkshire has done. Then he bought Wells Fargo in 1990. He sold it actually in 2020, but we are giving him credit as if he held it till the end of the year because mostly the stocks were going up. But if you look at it like that, from 1990 to now, Wells Fargo underperformed Berkshire, which means Berkshire's other stocks did better than Wells Fargo for the whole company to be of 14%. And then he bought American Express. And American Express is also, although very marginally, but it has underperformed Berkshire Hathaway. So actually the top three holdings of Berkshire, if he did not have, he would have done better, which means his tail has done better. Now, of course, you can say he had Apple, but look at last year what happened. So last year in 2020, what we've taken is the portfolio that he had at the end of 2019, top holdings which are declared in the 2019 annual report, and just seen if he had held them till 2020 end, what would have been the return? Returns would have been better than the S&P, but he sold them during the year. Let's not give him that negative thing. But look at it. His Apple was up 82% and therefore concentration helped. But just look at the performance of the second, third, fourth, fifth, sixth, seventh, eighth stock. All of them massively underperformed the index. So if you believe that concentration means you know something, concentration means you are confident of something, nothing works like that. It is a lottery. In this case, Apple went up 82%. So it made up for all the other things. But I don't think that is what we mean when we say if you're concentrated, you are knowledgeable and you're not ignorant. That's all bull. Quickly. So what have we found in the last 25 years? Okay, let's ignore this slide for the moment. Okay, so our summary is that no one knows anything about anything beyond a point. And if anybody says that he has a formula or that he's overconfident, you know he's just trying to hard sell you. This I've already done. So let's go on. What we have learned. So first thing is be the casino, not the gambler. What does that mean? So we believe that you should own more stocks, that you should own 30 to 35 stocks. Even if you own 40 stocks, it's okay. Peter Lynch used to own more than 100 stocks and beat the market by 12, 13% per annum. Actually, you can easily beat the market with owning at least 50, 60 stocks. I'll show you. But anyway, we own 30, 35 stocks. And what do we mean by saying be the casino and not the gambler? Is that in a casino, there is a small advantage that the casino has over the gambler. And that is why the casino does not lose in the long term. Although in the short term, some gambler come and he wins on blackjack or he wins on roulette. But in the long term, because there's a statistical advantage to the casino wins because the game is played repeatedly. So for example, if you know the roulette, which has 36 numbers, and you get 36 times your money, the advantage to the casino is that actually there are not 36 numbers, there are 38 numbers. Because there is a 0 and a double 0 and then 1 to 36. So there are 38 places where the ball can go and you are going to get 36 times your money. So if 38 people were putting on all the 38 numbers, one guy will get 36 times and the casino will keep 2. And it is that small statistical advantage, which is why you can never beat the casino in the roulette. In the blackjack, it's a similar thing. That if you get more than 21, you are out. But what happens is if the dealer is serving, and you have got more than 21, the game is end, you have lost. They don't check whether the dealer also would have got more than 21, in which case he also would have been out, in which case it would be like a draw. But no, you have lost, you are out. So that small advantage makes it. So how do we do it in the stock market is that if you don't play the game repeatedly, you are gambling. Let's say that with our research and our model and some great insight, we have 2, 3, 4, 5% advantage over the stock market, in the sense that the stock market is just the index, which is nobody's analyzing at an index level. So these are the 100 stocks. And with your research, you can reject some stocks. And so your success rate in beating the index is like a few times, like 5, 7% higher rate than just the 50%. If you play the game only a few times, you can be a winner sometimes because by chance you bought some HDFC Bank in your life, but broadly it will not work. Your broadly to work if you put bet more times and let the stats work, particularly in the long term. Now here it is. I'm just showing you that we have held HDFC Bank for 25 years. But does anybody really believe that I, in 1995, suddenly figured out that HDFC Bank is the biggest thing that I can own in my life? I bought 2% because it was, as I'll show you, there was nothing wrong with it. But who knew how well it'll do? And it's over maybe 10 years later that we would have bought more and added and made it 6% and 7%. But nobody knows these things to say like the way we do today, that if you bought HDFC Bank today, your last 20 years return would have been 20%. No, because you would not have bought it at that time. So we say that building a portfolio, and this is the real part now, you need to answer 4 questions. Which stocks to buy is obvious. The second is, what is your time horizon? Over what period will you own the stock? Or at least your research, and how many stocks to own at a time and when to sell, quickly. So which stocks to buy? We say, like we were saying in the beginning, we don't know. We should start with what not to buy. So if there are 100 stocks in the universe, there are 2 ways of beating it, the market, which is the average of these 100 stocks, is to either buy 20 stocks or to not buy 20 stocks and buy 80 stocks. Now, we don't have to actually buy 80, I'm saying as a concept. And it is much, 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 much easier to say what not to buy than to say what to buy. It is like saying that an employee steals money, he's bad. But if employee does not steal money, we don't know what it means. If an employee works hard, he may be good, but he may not be good because he works hard, but he doesn't give output. Let's say an employee gives output. He may be good or he may not be good because he may be harassing women or he may be embezzling money. But if you say the other way around, he does not deliver results, he's bad. He harasses women, he's bad. He embezzles money, he's bad. So the bad's definition are very easy. There is no definition of good. The good is just that if you couldn't find anything bad, please give him benefit of doubt and do some more research if you want to. But broadly, don't think that you know what is good, because good comes with, there is no end. A company is good management, but does it have a long history for us to know? It has a long history, but is the price low or not low? But what if you just said, I will not buy the most expensive company one, I will not buy the most leveraged company one, I will not buy where the government interference is too high, I will not buy one company only, and you bought the balance 80 companies. Nearly every year of your life, you will beat the index. I have not beaten it every year, but at least 80, 85 times the time, 85% of the time, maybe 81, 82% of the time, by not trying to figure out what is good, but by trying to figure out what is bad. So we have this checklist on themes, and then on industry, then potential for disruption is a new factor, company management, corporate governance, financial analysis, and medium-term triggers and valuation. And you just remove. What you buy, you will have less conviction. What you will reject, you will have higher conviction. That is what I was saying in the beginning, that your conviction will not be that I am super confident on even HDFC Bank because there's just been a management change, but I'm very confident I don't want to buy some other things that I have not bought. Once in a while, mistakes will be made, of course. Doesn't mean that everyone will work. But this formula works more consistently than trying to say, I have found a gold mine. Because A, you haven't found it. It has been found and now you are piling onto it. And nobody knows when those things will end. But that does not mean that we will not hold these for a long time as we continue to evaluate. But we will buy them with I'll show you that. Sorry, next. So how many stocks to own? Now, there's another theory which, again, Buffett and his chamchas have spread, that very, very few stocks do well. Therefore, you should own 10 stocks and 20 stocks. It is just mathematically not right that only 20 stocks can do well. Let's look at the S&P 500. There are 500 companies in the index. You have to beat the average return of that index, which must lie somewhere in the middle. It can never be the case that in an index of 500 companies, only 20 companies beat that average and 480 got beaten by the average, because the index is an average of these 500 companies only, the return of these 500 companies. So if you look at it, see year 2005, 245 out of the S&P 500 companies did better than the average, and the balance 255 did worse than the index. In 2006, 234 did better, blah, blah, blah. There cannot ever really be a year where only 20 companies will do well. So I don't even understand from where this theory comes that only 20 stocks will add value, because our first level is to beat the market. But let us say that in the US, in each of these years, which we have taken as the life of our own Helios Strategic Fund, that you could only buy, with your great research, 150th best performing stock of that year. You could not buy the 10th best or the 20th best and the story spread by Buffett and brethren, but only the 150th stock each year. Or of course, if you had got something better, even better, but let's say the 150th, your return would have been 1830%, while the market is up 331%. If you do it for India, it will blow your mind off. We have only taken 300 companies. And again, we are looking at the 90th best stock, which is 30%. There we were taking 150 out of 500. Because India is very volatile. Suddenly you'll have a Dixon go up 300% in a year, which at the beginning of the year, you may never have thought. But if you could only buy the 90th best stock of each year, you would have been up 57 times, 5,598% return versus the market up 8 times or 700% return. So the point is, a large number of companies do well each year, 2 years, 3 years, 100 years, because it is arithmetic. It is not to do with our government or US taxes or US creativity. It is to do with arithmetic, that if you're calculating an average of 300-500 companies, the average return will be somewhere in the middle. It will be plus minus based on market cap and all. And therefore, if broadly speaking, 45-50% companies are going to be on one side of the index and 45-50 on the other, then 30% will beat that 45%. It is just arithmetic. And 20% will beat it even more. But there is no need to dream that I want the best company of India in terms of stock performance, because you have no idea which will be the best company for the next year. And therefore, you buy 30-35 companies and hope with your research, because you couldn't find anything bad in them, that some of them will turn out to be perfect in terms of some news or some short-term trigger. But when you went in, you did not have that idea. When we bought HDFC, we bought Bajaj Finance in 2011. And we sold it last year. But in 2011, you think anybody would have thought, including the management, that this will be a $35-40 billion company? No chance in hell that they also knew. So we say buy with a 1 to 3 year view. And if it does well, please continue to hold it. With a 1 to 3 year view, you can imagine that what can happen. The management is the current management, the environment is the current environment, and the strategy is the current strategy. Long term, they themselves have no idea. Just one line on this, that Steve Jobs, when he died in 2011, 80% of his net worth was in shares of Walt Disney. And he must have no idea that Apple will be the biggest company in the world in 9 years. Otherwise, he should have moved his Disney shares into Apple. Bill Gates, out of his 125 billion net worth, less than $15 billion is in shares of Microsoft. He did not know that Microsoft is a better investment than everything that I'm diversifying into, because nobody knows these things. You just broadly know that you're trying to do a good job, and then some will work and some won't work. So our portfolio construction thing is, quickly, this I have done. So let's say if I look at for the last 15 years, again, this life of our fund, HDFC Bank is up 23% per annum, but ICICI Bank is up 15% per annum. So it looks a great idea that we had HDFC Bank as our top holding. So what great guys we are. But over the last like 3 years or whatever, HDFC Bank is up only 12% per annum, but ICICI Bank is up 33% per annum. TCS, which also we've held for the longest possible time, is up some 23% per annum over this period. But you look at it over a shorter period, then in TCS up 25% and India Mart is up 229%. And Dixon is up some 226%. We don't own India Mart now. We sold it in Feb. But I'm just saying that a portfolio cannot be frozen. The reason why we made whatever 300-400 pre-fee when the market is up 20 times is not because we bought stocks that went up 400 times, but because in between many stocks went up like that and then didn't do well. Like Z, in 1988 to 2000, it went up 100 times while I was holding it. And now it's maybe down from that period also. But at that time, we were not speculating. We were not saying that in 2020, this company will disappear, so I should not be owning in 1998. It was one of our 2-3% stock bets. Aban Lloyd went up 100 times very recently in 2004 to 8 or 7. We were not speculating that we know in the end this company is going bankrupt, so we shouldn't own it now. We were buying 2%. At that time, it looked fair for a 2% bet, and it worked. In fact, Unitech, we made 5 times. The stock went up maybe 100 times between 2004 and 8. And we were not speculating that this guy is corrupt or this guy is going to go behind bars, so I should not be owning it. We were saying it's a real estate company, new sector, new thing. It has got a lot of land, blah, 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 buy 2%. So that is the game. The game is not to say I want a 100-year winner, because there is none. So we say a portfolio construction, now I have to do it fast, should have 2 kinds of stocks. This is the final, let's leave it here, then questions, is that you need 2 kinds of stocks. One is where there is high confidence. But when you get high confidence, there is no return going to be made. It will be a reasonable return, which in today's context is HDFC Bank and Kotak Bank and TCS and Dr. Reddy and Bharti. It's not going to make you 30-40% return. It will make you 15-20% whatever return, where there is confidence is there that the management is good now, that the history is good. Now we know that it is good, and so on and so forth. And then there is a second group where you could not find anything wrong, but you don't know. You don't know what will happen. This could be stocks that are suddenly down a lot, or stocks that are relatively new. And you say, I couldn't find anything wrong on those factors. It is not from a bad industry. It doesn't have bad management. It doesn't have bad history that we know. It doesn't have bad corporate governance as far as we know. But beyond that, who knows? It has reasonable, some triggers. And if it works, great. And if it doesn't work, it'll break even and we'll move on. And you buy 2-3, or there are stocks that are down a lot. It could be some IndusInd Bank down 70% in 1 year, or Indian Hotels last year. And you say, now we don't know when will it recover, but it looks otherwise all right. But you are not going to buy it in a concentrated fund of 8-10%. But if you ask me to buy 2%, I'll buy it. And in that portfolio of 15-25 stocks, some will do very well, some will break even, and some you will lose. And that is how you will be there in all these things. So that is the whole idea, that you cannot do anything with super confidence, because super confidence, first of all, itself is a wrong thing. And when to sell quickly, there are many reasons to sell. But the practical one, I'm not talking about where the company is doing badly, it's okay, then obviously we'll sell, is where year after year, the earnings growth is much less than the stock price movement, particularly in that first group of shares where the stocks was already well known. If the stock is a new discovery, like in our second group, then it will outperform the underlying earnings growth. But you can't have stocks where for 10 years the earnings growth is 15% and the stock price has gone up 25% per annum in a stock that was otherwise also well known. One good example of that could be Nestle, where for the last 10 years, the revenue growth is like 10% and the profit growth is also some 9-10%. And your earnings growth, stock price appreciation is 24-25%. It cannot work. It has not worked. And I can tell you 100 examples where it has not worked. Over time, you can't get all your returns from re-rating of a company that is already in the high confidence in reasonable return story, which is that anyway people know about it. It has to be a backbone kind of a stock, that it will do well in a good market and won't do badly in a bad market. But it is not supposed to give you that higher return coming solely from uh, higher and higher valuations for the same low or lower than market growth. So that's it. I think I'll stop here because I think my time may be running out. Let's go for questions, sir.
Sure. Thank you so much, Samir. It was an extremely insightful and passionate presentation, I must say. So, audience, if you have any questions, please put it up on the ask question tab. In the speaker name, please mention the speaker's name so that it's easier for us to know you are addressing the questions to Samir. Okay, we have the first question here. So, Samir, what sort of risk control structures do you have in place to manage your funds investments during different market conditions?
So first of all, when we talk this from a foreigner point of view, we say we can't get away from the India risk or the currency risk. But at a portfolio level, the fact is, as I said, we are owning two kinds of stocks. Instead of letting the investor say that you choose one which is large cap and one which is mid cap or something like that, we are by buying 30, 35 stocks and limiting per name. So for us, the per name is that we cannot buy above 7.5% of the, not of the company, but of our portfolio. And at 10%, it must be reduced to 10. But I can tell you that in the last 16 years of running Helios, we have not even once let a stock go to 10%. So many people, these foreign guys would tell me that since you have so much experience, why are you not more concentrated? And the answer is because of that experience. So we have two levels of limit, one for the top 250 companies in India, where the limit is 7.5% and cannot go above 10% with appreciation. And for the smaller companies, cannot be more than 4% per name and cannot go above 6%. But again, we've never reached that limit. We are very happy with 2% positions in the smaller group and 4-5% position in the bigger group. The idea that if the stock is so good, how will it change your life if you only buy 2%, is because you don't know it is good. And forget about you, the management does not know. These stories that are sold now, I have lived through all of them, of owning HDFC Bank and Kotak Bank and TCS and all. The story told now is as if it was obvious. So let me tell you that in HDFC Bank, Aditya Puri himself in a recent interview said that when he joined, because he moved from Malaysia to India and all that, he wasn't sure of the bet. This is in an Economic Times interview. And he said that 2 years later, when they won some banking award, they celebrated in their office that they have now survived or something like that. So who, if they themselves thought like this, how would the outsider have come in and bought 10%? In Kotak, there was a recent study of how much value Kotak has added in 25 years. But the reality is 25 years ago, it was not a bank. It was a broker. And who would have bought an Indian broker in the 90s? It became a bank in 2003. And therefore, in theory, if you wanted to analyze the bank and how it is done and how it has graduated from being a broker to a bank, you could not have bought it in 2004, 5, 6, or 7. So what is the point of saying to the world that if this bank had been around if this investment had been around from 96, this would have been the return? But we were living and we had it. We used to own 5% of Kotak in 2002 before it became a bank. And the total cost of that was $2.5 million for 5% of the whole bank. Its market cap was $15 million because you could buy this much only. You are supposed to bet 2-3% and then see how the managements do it. And that is how the risk control comes.
Sure. Moving on to the next question. If 50% of the companies outperform the index based on arithmetic, why is it that majority of fund managers still underperform the index?
First of all, 30 don't outperform. 40, 45 outperform, 55 underperform, 30, I was saying, is such a big difference from 40 that if we say in our mind that, because what we are trying to do is say, do you think we have a chance that our company is in the top 1/3 of India in terms of performance? Now, talking about the specific question why fund managers underperform. So first thing is, if you look at the portfolios of these bigger companies, you will find that they own 400 companies, not in one fund, but across the firm of one. So I don't think there's a single stock that they have not bought. I am amazed at what kind of stocks there, but before that, it's again a mathematical thing. Ultimately, the market is made up of all these fund managers. There is no outsider. You can say there's retail, but then they also are part of their group. Basically, the fund managers are playing a zero-sum game relative to the index because all the fund managers together are the market. So again, like it is for stocks in a S&P index or in an Indian index, that broadly speaking, half will outperform and half will underperform. It's the same case for assets. Let's say it's for fund managers, although it's technically for assets. So let us say half outperform and half underperform. But now there is a cost of the management, which is say 1.5%, 2%. Because of that 2%, instead of half beating and half beaten, some 35% will beat and 65 will be beaten, because some of them will come that they will beat an index if they had no fee, but they have a fee. Therefore, the next problem is that because these guys are, in my mind, concentrated, even if they have a lot of stocks, I'll explain, they will not beat the market every year. And therefore, over slightly longer period, in some years that guy's beaten, in some years this guy's beaten, and over time, some 25% guys will beat the market. Now, what I mean by concentrated is, you look at, I don't want to name because they are my friends and also at some level my competitors, but you see how aggressive views they take. So one of the biggest fund managers of India for 7 years said, I will only buy cyclical stocks and economy stocks and beaten up PSUs. And 7, 8, 10 years have passed with that strategy. We don't want that. When I was a mutual fund manager, and even now, we don't want that kind of an experience for the investor where you say, see, over 10 years, I beat the market. But actually, all your return came because you were waiting for your market and your strategy to be aligned. Because for 9 years, you were being beaten. And maybe in the 10th year, you beat the market so much that over the 10 years, you did better than the market. Because investors are not coming in with that view. They are all coming at different times in life. And that is what I meant with the other thing, that let us say I say I buy right and sit tight kind of an argument that I never sell. I'm a long term and for 10 years, I will not sell a stock. So let us say I bought 10 stocks with 10% each. And because of the market, in 6 months, one stock became 12%. Because it went up 20, 30, 40%, whatever. And the other one stock fell 5, 10%. So it became 9.5% or whatever. Now a new investor comes into our fund or into the PMS. Now what am I supposed to do? For the new guy, will I buy 12% of that stock because the old guy has 12%? Or will I say, I will sell for the old guy because I want to give the new guy 10%? Or will I say, everybody's on his own. So after 1 year, some people have made a lot of money and some people have made no money and some people have lost money because of this thing, even after they were all in the same strategy. So therefore, you have to manage so that you are giving everybody similar experience. And that is why it is fund management. The idea why I feel that many of these guys lose is because they think stock selection is fund management. Stock selection is one part of fund management. That's why I was telling you the other 3 things. How many should you own? For how long you should look? And when should you sell? Because sometimes you will sell only because for the new guy, you're not willing to buy that higher position. And if you feel uncomfortable buying it for the new guy, at some level, it means you are okay with selling it for the existing guy. And we have done it so many times. And over time, these things work out. Sometimes maybe holding the original stock would have been better. But over time, as a fund manager, you have to do many more things than just saying, I found this stock and I will never sell it kind of argument. But the fund management being beaten by the index is arithmetic, that they are the market. And then there is the friction of the management fee. And then there is a friction of consistency across time. If you take aggressive views, you are trying to match the market with you, and then for 5 years the market will not be like you, and then it'll come back to your view, which is why the value guys don't buy growth, and the growth guys don't buy value, and the high quality guys don't buy a small cap, and the small cap guys don't. I don't understand why they are so narrow that they can't analyze two different things in one fund.
Sure. So, audience will quickly take 2 or 3 more questions. I think we are running out of time. So, Samir, moving to the
I have enough time. If you don't have, then that's your fault.
Yeah, no, I think we can take 2, 3 questions because after that.
Yeah, please take. Yeah.
So I'll move on to the next question. Which sectors are you banking on, or say avoiding, if that's easy, for the next 3 years? The horizon which you speak of in the PPT as well.
Yeah. So broadly speaking, we have themes we have chosen. I didn't show you because of time, but basically we broadly invest in 3 themes, which means 85% or so, because it's not that every stock in the country has to fit into my theme. But if it doesn't fit into the theme, it'll be harder to get into the portfolio. And the 3 themes are companies that compete with government companies, which these days primarily means financials, which is private banks and insurance and all that. The second is urban or middle class underpenetrated consumer, not India underpenetrated, because everything, if you divide by 1.3 billion, will look underpenetrated. And the third is, which was originally IT and now expanded over the last 5-7 years to pharma before that, IT, pharma, and specialty chemicals. These are the only 3 themes. If a stock is not in these 3 themes, like today we own State Bank and Bharti, then those together would be 10-12% of the portfolio, broadly speaking. Otherwise, 85-90% on theme ground would be in these 3 themes. Nearly all our life, but never full commitment, because if we want to buy something else, we don't want to be embarrassed, because the market is bigger than us. It is not I like these themes, so I will always buy these things. But realistically, these themes are most probable that you will find in our portfolio, and they have their own logic for doing well over time. And another way I look at it is that if you look at the Forbes billionaires list, all the top guys would be from these 3 themes. So I know that this is where wealth has been created in the very long term.
Sure. Question here. Do you employ any leverage to enhance your returns? If so, how much leverage do you generally use, and how is it distributed across different positions?
No, we don't use leverage, because in our long short fund, our net is only 60% average. So we are on average 100% long and 30-35% short. So it depends on what you call leverage. Some people will call our gross as leverage. And in our domestic fund, anyway, you're not allowed to use leverage. So basically, you can say no leverage, as in we are not having 100 rupees and having a 200 rupee exposure in the market. All those returns came without leverage. And in fact, not only without leverage, it came with a 60% exposure for the last 16 years.
Sure. Is there a particular niche of investors that you are aiming to attract for investments into your fund?
Would you
like to see the profile of investors?
One guy asked me that what kind of investors would you like? I said investors choose us. We don't choose our investors in that sense, because these are all liquid strategies. Even our offshore fund is liquid. Previously, I was the #1 biggest mutual fund manager in India. You could have as many redemption subscriptions. All that is part of it. That is why it is very different from individual investing, which is why I said there's a small fund manager role over and above stock picker.
Sure. So next question. If as you said, if nobody knows the damn thing about
anything beyond a point,
index investing, wouldn't index?
Sorry?
If nobody knows a damn thing, wouldn't index investing with smart beta strategies be a simple way to invest?
Well, smart beta investing could be for somebody. What I meant by that is that nobody knows anything about anything beyond a point, and therefore do not over believe in your knowledge to say I will own 5-10 stocks. We say, as I said, we are improving the odds like a casino. Now, in the short term, you could keep losing, but if you put very few bets, you could win also big, but you could lose big. We are saying that if the thesis is right, And unlike the market, I am not presented simulated performance or model performance or owning a portfolio now and saying, if I had it for 20 years, this would have been the performance. So, but broadly, it is true that for many people, it would be enough to own index. But this enhanced beta type things is again trying to be over smart. Uh, but we have done well for whatever reason. Now, as I said, even we don't know whether it was exactly these reasons which gave us this performance, but it is a bit different from the world. So we will always say active management, but we mean active management with us.
Any suggestions for a 20-year-old investor?
20-year investor has only one this thing: read all the books here and in my office. It is only reading which is the formula for an individual investor. See, if as a fund manager or as an institutional manager, we have a team, we have people who are attending calls, and we have people who are meeting companies, and I am meeting. None of that will be so easily available if you're an individual investor, and therefore you have to read books to connect things across time and across countries. A lot of money we have saved or made simply by looking, because we also manage global funds and all, by looking at what is we are doing in the US fund. The same things happen with a 6-9 month lag. If those stocks are not doing well there, they will not do well here. You can do what you want. If they are doing well there, they may still not do well here because some of things are not available in appropriate. For example, cybersecurity, very hot sector. We have a large exposure in our global fund. But when the Indian cybersecurity stock got listed a few years ago, there was no need to even look at it, according to us, because people can buy these things on net, online. They don't need a particular, it's like gaming. I mean, it makes no sense to say I'll buy an Indian gaming company, as if the Indian guy is restricted to buying some pathetic Indian game. He will buy a global game if he so desires, because he can do all these things online. So there are things like that which you have to connect. And that connection over time will come from uh, reading. What else will you say to an individual doing it on his own? So please read.
Super. I think on that note, Samir will have to wind up the session. We have to get
Thank
it.
you very much.
Thank you so much for taking out this time.
Thanks a lot.
I'm sure it was brilliant, and people who will be watching it later on the YouTube channel itself, I'm sure everyone's going to benefit immensely out of this. So
Thank
thank
you very
you, and
much.
we look forward to keep engaging with you.
Thanks a lot.
Thank you, participants. We see you at the next session at 5 o'clock. विशाल एक ही गड़बड़ है मुझे जो बार बार 2-3 सेशन से समझ में आ रही थी मैं बताना भूल रहा था आपको ये जो क्वेश्चंस पूछ रहे हैं ऑडियंस वो सीक्वेंस में नहीं आ रहे हैं तो कई बार पीछे के क्वेश्चन All right. So, Abhishek, can we get started with the session?
Yeah, sure. And
Thank you. Thank you so much. So, audience, welcome back for this very important session on how to conduct due diligence of AIFs. Uh, with me, I have a very good friend of mine, Mr. Abhishek Paronigar, who comes with 14 years of experience in private equity and investment banking. Abhishek is currently the director at Moravia Capital Investments, a global private equity fund of funds, and is in charge of the investments in private equity funds in Asia and North America. Abhishek leads the sourcing, evaluation, due diligence, investment, and portfolio monitoring of private equity funds in Asia and co-leads the same for private equity funds in North America. Abhishek is also on the investment committee of the fund. Prior to that, Abhishek was a partner at Moravia Capital AG and in charge of fund placements in Middle East and Asia. He was responsible for handling and managing relationships with institutional investors of alternative asset class in the Middle East and Asia. He was also in charge of business development sourcing clients in Asia with a focus on India. Before joining Moravia Capital, he was working with ICICI Bank in the global investment banking group. He was responsible for advising clients on a wide range of domestic and cross-border transactions. Abhishek has been honored with the 40 Under 40 Alternative Investment Professionals Award in the year 2020 by AIWMI. Abhishek is an All India rank holding CA chartered accountant and holds a degree in business administration with specialization in finance from SP Jain Institute of Management and Research. So, Abhishek, welcome for your first ever session with us. Glad to have you on board as a speaker this time. You've of course been a part of this conference, but as a winner of 40 Under 40
yeah,
award in 2020. But it is great to have someone like you coming and sharing insights on. I believe this is a very important topic because the community we primarily deal with is either investors or the wealth advice management community, and
mhm,
I have seen both of them asking this question so many times about how do we figure out, how do we do a due diligence on AIF, or how do we really find out or figure out which is the right AIF to pitch. So a question faced by the distributors and a question faced by the clients. And I believe we couldn't have had someone better than you to answer this for all of us. So over to you. You already know the format. The speakers are using Zoom while the audience is, watching us live on the virtual event platform. Audience, those who are new, especially, I mean, if you have, so Abhishek will be talking on this subject for 45 minutes. If you have any questions for him, you can use the request, ask a question tab and put in your questions there. I'll be happy to uh, address those to Abhishek on your behalf. So, Abhishek, what to you?
Thank you, Aditya. I mean, that was a very kind introduction. And thanks to the AIWMI team for having me here on this platform for the talk. And a special thank you to all the audience and the members who are listening for taking out time on a busy evening on a weekday and joining me for this masterclass on due diligence on AIFs. I hope all of you are staying safe and healthy in these times. So let me, Aditya has given a quick background on me. I would probably take 1 or 2 minutes and give you a quick introduction on Moravia Capital Investments so that the audience gets a better idea on the lens or the hat that we wear. So Moravia Capital Investments is a global fund of funds, and our mandate is to build a diversified international private equity portfolio for our investors. So in terms of strategy, we are investing across strategies, venture capital funds, growth stage funds, private equity funds, and so on. And in terms of geographies, we've been investing in the US, Europe, and Asia. So that's the broad mandate. And we've been evaluating funds for a while now, and we've built a healthy portfolio, about 15 funds. And probably I'll put some of those experiences here for the benefit of the audience. So let me begin. Did you know that there are more than 20,000 funds in the international market? And I mean, out of that, maybe more than 500 funds, active private equity funds in India. So that's a large universe, and it's not an easy task to identify and conduct due diligence on the best managers. I mean, all the investors who are putting in money in private equity are there for the long term, and you don't want to get stuck with a manager who's not doing the right strategy or not performing or whose numbers are not correct for a long period in time. So I think due diligence is of utmost importance in private equity. And one other peculiar feature about this asset class is that manager selection is really important as compared to the other asset classes. I mean, if you look at this chart, essentially the light blue bars is the dispersion of returns between fund managers of listed equities. So essentially what it says is that broadly, if you were a worst performing listed equities fund, and if you compare the performance with the top 5% best performing listed equities fund, the dispersion would be so much. And the dark blue bar is the dispersion between the returns generated by private equity fund managers. This chart essentially is for leverage buyouts, but that brings out the message that if you end up selecting a wrong fund, the dispersion could be as high as 55%. So, I mean, due diligence and fund evaluation are really the key things for getting the returns or meeting your objectives of returns from private equity funds. Now let's get into what makes it so challenging. I mean, what's so difficult? What makes it so challenging to conduct due diligence on private equity funds? Essentially three things. I mean, there are a couple of points, but these are the three key points that I would like to highlight. One is the lack of data and transparency. I mean, the data is of course available once you ask for it or request for it from the fund managers, but it's not easily available, and the transparency and the depth of the data is not as high as when you would be evaluating, say, listed equities fund managers, or if you would be evaluating investing directly in a listed entity. So that makes this investment challenging. The other point is limited benchmarking possibilities. I mean, taking a comparison with listed equities, if you were to ask Rohit Sharma, he will tell you mutual fund sahiye.com pe jao. I mean, and you will have all the information of all the fund managers, their performance, their portfolio, or you can go to Morningstar or Money Control or any such website, and you will have a host of benchmarking possibilities. You will have a lot of data which you can collect, you can compare, and so on. But that's not the case with private equity. I mean, how do you judge the performance of a private equity manager as compared to other private equity fund managers? How do you know that he is outperforming the manager under consideration, is beating the market, or he is outperforming? That's a challenge. There's no real benchmark or an easy benchmark that's available. Last year, SEBI's come up with a couple of benchmarking rules, but that is still very nascent. I mean, it gives limited data as of now, but I'm sure this is going to grow going forward, and this is a welcome step and a good beginning from the regulator and the industry body who's managing it for the time being. I think that's a great step, and hopefully going forward we would have more data, more comparable numbers to help with analysis. And the third point is long time lag between commitment decisions and performance outcomes. I mean, typically the investment period of funds is anywhere between 3 to 5 years. So from the time you make the decision to invest in a private equity or an alternative investment fund, the fund manager would take 3 to 5 years, and you give maybe 1 or 2 more years for the real performance to show. And that's a long time period to figure out whether the decision that you've made to invest in the fund is going right or is not correct. So that time lag kind of makes the process of applying the learnings to your other investments kind of difficult and very slow. So that makes it challenging when you're conducting the due diligence and applying those learnings going forward. One other stark difference when conducting due diligence, what private equity fund managers do when they invest directly into companies, and what LPs do when they commit or when they invest into private equity funds, is that when you are doing a due diligence on a direct deal, there are so many avenues that you can check, and you are essentially getting into that same company or that asset which you're going to own when you're making an investment. So your due diligence would reveal whether the revenue numbers or the EBITDA numbers are correct, whether the assets and the liabilities are recorded correctly. Would the EBITDA be different? Are there any adjustments that need to be made? If it's a financial services company, are the bad debts recorded properly? NPA numbers are correct or not, and so on and so forth. And based on that, what you can do is you can defer your valuation number. You can tweak your valuation and you can say, okay, if the EBITDA is not going to be 10 million and it looks more like 8 million post DD, the valuation is going to be X times the EBITDA. So you can adjust your valuation accordingly and still take a decision. But in case of investment in a private equity fund, the decision is binary. Either you invest or you don't invest. You cannot say, I will invest, but at so-and-so valuation. So that's a stark difference. So DD is kind of really different as compared to doing a direct deal. And also the parameters we look are different. I mean, when you are investing in a new fund or the next fund of a private equity manager, you can only do DD on the previous funds that were there. But essentially, you're not going to be investing in those funds. That only can give you a sense on how the manager is behaving, how the systems are, how the accounting is, and so on. And you would be investing into a blind pool of fund, which would invest in or which would acquire assets in the next 3 to 5 years. So it's kind of challenging as compared to the usual DD that we do for direct investments. Maybe now let's get into some of the key aspects which from our experience are the most important when evaluating a private equity or an alternative investment fund, and also part of DD. I mean, some of these items are part of due diligence, some of these items are part of evaluation. We do bits in evaluation, and then based on our decision, when we conduct a detailed due diligence, we check those aspects once again, and so on and so forth. So I'm combining both these aspects here and not splitting them on what are the evaluation items and what are the DD items. Essence is to give you a sense on the parameters that we consider or which a typical LP would be considering when they are conducting due diligence on underlying funds. First to start with is the strategy. I mean, these are the four parameters which you see here: strategy, track record, theme, and execution and other fund terms. These are the four broad heads that we believe are most important. Let's get into the strategy aspect. When we look at strategy, the key thing that we look for upfront is whether this strategy will fit within our portfolio construction or not. I mean, the strategy might be doing very well, might be generating returns, and so on and so forth, but does it make sense within our overall portfolio or not? That's the first checkpoint for us. And if that ticks in, then probably we go ahead and we believe, yeah, okay, this is something for us, something for our portfolio, and something for our investors. Next point we look at is whether the particular strategy under discussion would make returns in the current environment. I mean, the fund manager would show his or her past track record, how well the strategy is done. But the point of discussion within the team is that whether this strategy makes sense now at this point in time. I mean, maybe a strategy which has worked 5 years back may not be the best strategy today. Maybe the space is more crowded now. I mean, there are more PE funds who've come in making deals in the same space, driving up valuations, or there aren't sufficient deals in that space now. Could be anything. So essentially what we need to evaluate is whether the strategy would make returns and does it make sense in the current environment. I mean, take example of, say, VC funds investing in consumer deals or enterprise SaaS. Probably that was a space 5 years back, and now it's maybe overcrowded and valuations going over the roof. We don't know. I mean, we'll have to see. So points like those, I mean, that help in terms of making up our assessment on whether the strategy makes sense at this point in time or not. The next point then we look at is how different is this strategy from the rest of the players in the market. And I tell this to a lot of people. I mean, if the strategy for everyone is the same, if everyone is doing the same thing, then the returns are going to be the same. If you do something different than what the rest of the competitors are doing, then probably there's a chance of making better returns as compared to the rest. That's what we believe. So we need to look for a differentiating factor what helps in generating better returns as compared to the competition or other funds in the market in the same space. And this could be anything. Does the fund have better sourcing capabilities? Do they have better value addition capabilities? Do they have in-house teams which can help the company grow revenues and profits faster? Or do they have the ability to buy deals at favorable valuations? Anything. I mean, those are some of the thoughts or some of the examples that I have, but that's essentially what determines whether there's a differentiating factor or an edge as compared to the rest or not. I mean, let me take one example here of what we saw in 2019. This is when we were conducting due diligence on a couple of buyout funds. We were looking to invest in the US. I mean, that's also a market I've been looking closely. And typically in the US, what happens is the leverage buyouts, the funds like to acquire companies which either come with a running management, that is the existing management, or the promoter is going to continue for a small share in equity. Maybe they leave 20 to 30% for the promoter, and the promoter or the existing management continues to run the business. I mean, the leverage buyout shops in the US have a lot of value add or capabilities which they help the company grow, but they don't want to get inside the company and the run company on their own. And that's the majority of the buyout shops that we've seen. And we came across one fund which was doing really the opposite of this. They said that we don't want to buy companies which come with a running management. We want to buy companies which don't have, or the CEO or the promoter does not want to run it. So they were looking at companies like that. And what they did was they've built a team of CEOs, the best-in-class CEOs running mid-sized companies, and they've already hired them and kept them on the bench. So what they're saying is, we have the CEO who will run the company, and now we will find a company which he can run, which fits his abilities. These are best-in-class CEOs. So we will find companies which make sense from an investment point of view. And we have a CEO who is going to go inside the company day one and knows exactly what he needs to do. And we really like that strategy. Of course, there were other elements of the strategy which also we liked, and we invested in that fund, and that fund is doing really well. So examples like these, what make funds different from the rest and help them in doing better deals and generating better returns for the investors. On the strategy, other thing which we look for, is there any deviation from the previous fund strategy? I mean, the track record on which we rely, which belongs to the previous funds. And if there's a change in the strategy for the new fund, that really does not gel well with the investors. So we really look for aspects like these, whether there's a shift in strategy. I mean, if, for an example, if the fund was doing maybe seed stage or pre-series A kind of deals, and in the new fund, they're looking to do series B deals, then yeah, probably that's not something what we would look for. Similarly, a related point is an increase in fund size. A lot of times, managers increase their fund size out of proportion. And then what is important while doing the due diligence is to see whether they are moving out of the space of the strategy that they were doing in the previous fund, or they are sticking to that and going to do more deals. And if they are sticking to that strategy and going to do more deals, what is important to see is that, do they have the bandwidth and have they increased the team size in order to take care of the additional deals that they need to do? Yeah, so these are some of the aspects we look in the strategy. The other thing that we also look at, which is gaining much importance in these times, is the ESG aspect. I mean, we always were looking at well-governed funds. So the governance aspect was always important. But yeah, I mean, environmental and social concerns are also very important now. And we would look for strategies or funds which adhere to the ESG standards in some sense or the other. So that's also an important aspect going forward. Let's move on to the next parameter, which is the track record or the past performance. And as I said, I mean, essentially the LPs are investing in a blind pool of funds, and what they rely on the most is the past performance of the fund manager. And in this, the key aspects we look at is the absolute performance, relative performance, and also the consistency of performance. Absolute performance means we're going to be looking at the IRR numbers, the TVPI numbers, and so on. And from a due diligence point of view, we really double check or do the calculations for IRRs and the TVPI for ourselves. I mean, of course, the fund managers are doing it and sending it out. But yeah, we would like, as our due diligence exercise, to check these numbers once again, check the Forex rates, those are used. Read the footnotes very carefully, because yeah, I mean, those are interesting footnotes. You would find out what's gone into the calculations and what's not gone into the calculations from those footnotes. So that's something which investors need to keep in mind when they are due diligencing on the numbers. And of course, I mean, net numbers are more important than gross numbers. We would like to see what are the returns the investor would make post carry, post expenses and fees, and so on and so forth. The next aspect is the relative performance. I mean, this is easy. You can be looking at absolute numbers, and yeah, I mean, those might be looking good, but it really doesn't make sense till you compare it with what's happening in the rest of the market. I mean, maybe similar vintage, similar strategy, other funds are doing maybe much better. That gives an indication about the quality of the fund manager. So doing a relative benchmarking and comparison with other funds is also important. And also comparing with the listed equities index. I mean, we have something called as a PME comparison, which is also important, which essentially says that if you had invested similar money at similar time frames in listed equities of a benchmark, what would you have made? So that's a comparison with listed equities, which kind of makes sense. And the next thing which is interesting, which we look at, or any investor should look at when evaluating the track record, is the consistency of performance. So consistency of performance across previous funds and also across deals. A lot of times what happens is the performance of the previous fund is looking really good, but that's more so because of maybe one hit deal that he's had where it's an 8x or a 10x, and maybe the other deals were just about okay, but the overall fund performance looks good. So what one could do when performing due diligence is that leave out the top performing deal and the worst performing deal, and then just evaluate the ones in between. That would give a sense on whether this is more of a one-off performance or this is more a consistent performance. And with, I mean, if there's sufficient data available, what we also do is do a lot of slicing and dicing of the past track record and numbers in terms of how have been the returns by segment, how have been the returns by stage of deals, venture capital, growth stage, or late stage, and so on. We also do slicing by sector, whether it's a healthcare deal, those are performing better, or technology deals are performing better, and so on and so forth. So that's really the interesting part when comparing the numbers and figuring out which are the consistent performers, which are the relatively better performers, and then make up the decision. The other important aspect on the track record, not so much in the Indian context as of now, but I'm sure this will gather steam in the years to come, is the use of credit lines. What we are seeing a lot in the US and so on and so forth, also in Europe, is that more and more managers are using credit lines to bridge the gap in terms of capital call money coming in from the investors and the deal transactions being done. But I mean, over the past years, it's more become a game to boost the IRRs. What essentially the fund managers in the US and Europe can do is borrow money from the banks at a lower rate because the interest rates are so low there, and defer making capital calls to their investors. And then, I mean, these are short-term borrowing lines, a year to year and a half. But yeah, I mean, they utilize it to the fullest and then repay it using the capital calls from the investors. What that does is it kind of helps them boost the IRRs by a couple of percentage points. So we try to analyze the impact of credit lines on these funds and try to compare apples to apples, and then, yeah, I mean, make a decision while evaluating these funds. And the last aspect on the track record is to look at the valuation methodology used by the fund managers. A lot of times what we see is that when the manager is about to get into raising the next fund, they would maybe boost the valuation of the unrealized portfolio of the previous fund. So optically, the numbers look much better. I mean, we try to dig into all the previous quarterly reports and see that the valuation methodology has been applied consistently across quarters for all the assets. And that gives a sense on whether the valuations put in the marketing material are reasonable, or are they conservative, or are they very aggressive. I mean, we need to have the skill to be able to see through the marketing that comes in a marketing material. Yeah, I think these are the key points. I mean, just to stress once again, I mean, past track record is really important, because that's the crucial aspect which defines how the fund manager hopefully would do in the future. Moving on to the next point, or the next aspect for due diligence, is the team. Again, I mean, probably I'm repeating myself, but yeah, essentially we are investing in a blind pool of capital, or a blind vehicle. We don't know what's going to come in. So what we are relying is on the managers to make the best investment decisions. So evaluation of the team is definitely an important aspect while conducting due diligence. And here, I mean, there's not much quantitative data that would be available. You really have to rely on qualitative and softer aspects when you are judging some of these parameters about the team. And yeah, I mean, in times like these where physical meetings are not possible, it's difficult to figure out some of these aspects. But yeah, this is definitely one aspect where physical meetings would have helped much better. Let's get into the key points, maybe run through them. Quality and experience of the team, that's the three criteria. How deep is the experience of the team members? What is the quality? Have they made investments in the past? How many deals have they done in terms of investments, their previous roles, previous jobs, and so on? And one key aspect that we look for is whether the team of managers have seen business cycles in the past. Have they seen one or two crashes in the past? Because when we are investing in a private equity fund, the fund life is 8 to 10 years. And every couple of years, we see a major correction in the market, may it be due to COVID or great financial crisis or dot-com bubble and so on. So essentially, in that 8 to 10 years of the life of the fund, definitely there's going to be one big correction or a big crash or a crisis, so to say. And if the manager is fairly new and have not seen a crisis or experienced that before, then it's going to be difficult to navigate from a crisis like this when it comes in the new fund. So this is something important that we look at. And of course, the size of the team is also very important. How many professionals do they have? Do they have the bandwidth to do the number of deals that they promise from the new fund, and so on? The next aspect is the cohesiveness and stability of the team. Here, we need to figure out whether the team is really gelling along well, and whether the team will remain stable for the next couple of years in the new fund. Just taking an example, I mean, we were evaluating one fund in Asia, and very good team, very strong past track record. And there were 3 partners in this fund. And one of them, I mean, they had mentioned in the marketing material and also in the meetings that one of them is not going to be full-time with the fund. He's going to be dedicating majority of the time to the fund, and maybe not being involved 100% of his time for the fund. And that person had a really good track record in the past, and we were not sure how long or what is going to be the quantum. I mean, of course, the fund manager is saying he's going to be involved for a majority of the time, but we wanted to dig in deeper into this. And when we had one of the meetings in their office, that's when we picked up a softer cue that there were only 2 cabins in that office for the partners and not 3 for 3 partners. I mean, of course, real estate in these large cities in Asia or elsewhere is expensive, But yeah, I mean, we would have expected three cabins to show that the third partner is also going to be substantially involved in the next fund. So things like these, I mean, you have to pick up cues like these to figure out whether what they are saying about the team is true or not, and whether the team is gelling along well or not. I mean, just taking another example where, again, the team was very cohesive on the paper. They had worked for a couple of years in the past, but when we went for a meeting with them, we could see visible differences in opinion within the team, which is something what we don't like. I mean, the team should be there with the investors for the next 8 to 10 years. This is a long-term game, and we're not really looking at teams which would just invest and maybe not be there. I mean, the key people whom we are trusting should be there for the rest of the fund life. That's the key aspect. And related to that is the key man risk, whether the key person of the fund will remain with the fund for the rest of the tenure of the fund or not. That's something we need to judge. And also whether for whatever unforeseen circumstance something goes wrong with the health or an accident, if that person is not there, what happens to the fund? Is the next in line team capable to deliver on the strategy and make those investments and generate those exits? That's something what an investor needs to look at. I mean, just taking one example from the US, where we had a very strong leader who had generated fantastic returns over the past 20 years, made 4 or 5 fund generations, successful investments. And probably we thought that there is a very strong key man risk in that, because he was an extremely aggressive leader, leading the team from the front, dictating the culture. But what we realized when we had a couple of meetings with him, that he had built a very strong next in line to succeed the fund, just in case something goes wrong with him. And we could see that the next in line were also talking the same culture and had the same aggression and zeal to make returns for the investors. And we finally committed to that fund. That fund is also doing quite well. And the last aspect on the team is the alignment of interest. We would always love as investors to see that the team is aligned with the success of the fund. And this is usually achieved by a GP commitment. I mean, the managers putting their own money into the fund, the team putting their own money into the fund, the carry split amongst all team members so that they are motivated and remain with the fund. Things like these, which help in determining the alignment of interest. Yeah, so that's on the team aspects. Let's move on to the next or the last most important aspect that the investors should look for is the execution of the strategy and also fund terms. Execution, of course, deal sourcing, very important. I mean, when you meet managers, everyone would say that they have a proprietary deal sourcing. And when we conduct our due diligence, that's one of the key aspects that we need to see whether the deal sourcing has been proprietary or has been same as what the manager is promising or is mentioning in his material. That's an aspect that we need to look for. The other aspect is the value creation. This is really important. I mean, every fund manager has the money which they are investing. So the companies, the investee companies are definitely looking for more than the capital that the fund brings in. And that's really the differentiating factor. I mean, it's really important for buyout deals, but it's equally important for growth stage deals. And every fund manager says that we do value creation for our portfolio companies to an extent. But yeah, I mean, the crux is in seeing what part of that is real in terms of what they are saying. So if an investor looks at the past deals and what concrete examples the fund manager has to share about it, that would give a sense on what's really the extent of value creation by the underlying fund. Next aspect is the investment and the DD process. I mean, just the way the investors have their own investment thesis and the DD process. I mean, we would like to see that the underlying funds also have a very institutionalized and a robust process and an in-depth process for conducting due diligence. I mean, in fact, their DD processes need to be much more robust and deeper than what LPs would be doing on the fund managers, because essentially they are getting into operating companies, live companies, which have operations, which have revenues, assets, and liabilities, and they need to make sense whether the company will continue to grow and will deliver the returns that the investors are looking for. Yeah. And then the last aspect, but very interesting, is the fund terms. I mean, fees, carry, these are the things that we need to look at. Broadly, these are the aspects where we would like the fund managers to be more transparent. Of course, that's the case in India. Things are very simple, very transparent. It's not very difficult. But I would just like to draw one example of a manager we saw in US. I mean, a couple of years back, I mean, when we were not doing fund investments, or when I was not doing fund investment earlier on in my career, I read articles where it said that the US pension funds are worried about the fees they are paying to the underlying fund managers, and they don't know how much fees do they actually pay up to the underlying fund managers. And there was a big hue and cry in the US, in the industry, and so on and so forth. And I was wondering, what's the fuss so about? How can it be so complicated? It's so easy. It's 2% of the capital commitments. That's as easy as that. Why is it so messy? And in 2018, when we were evaluating a couple of highly successful buyout managers in the US, I found myself in the same boat. I mean, I just could not understand what's the amount of fees we will end up paying to that fund in the end. I mean, they sent us an Excel sheet with the fee calculations, with the waterfall in terms of the deals, exits, and so on and so forth. And it was really complicated. I mean, there's management fees, there's transaction fees, there's monitoring fees, there's fees for the operating professionals, there's incentive to operating professionals, there's shared expenses, and so on and so forth. I mean, you just can't figure out what's going to be the final fee amount that gets paid by the investors. And some of this gets set off against the management fee. Some of it does not get set off against the management fee. It literally took me 2 days to decode that Excel sheet. And I must admit, I still don't have a clue whether I understood that completely or not. So yeah, I mean, that's the situation in the US, but yeah, fortunately, that's not the case here in India. It's pretty straightforward in terms of the calculations and the transparency aspect. So yeah, I think that's also something that we need to look at. Yeah, and what happens a lot of times in fees is the transaction expenses are also something an investor should look for, because in the end, these are paid by the fund investors. So that's something we need to take into account. Again, I mean, just a note of caution here. Higher fees or complicated fee structure or higher transaction expenses does not mean that the fund is not good. It needs to be seen in the context of what's the objective or what's been achieved by these high fees. It could be the case that these high fees are for a reason and they generate a differentiating factor which helps the fund manager in generating much better returns than their competitors. I mean, just so the previous fund which I was mentioning, they had a very strong operating professionals team of about 30 professionals in-house who would then go into these acquired companies and help those companies grow. I also mentioned about the previous fund, I mean, at the very beginning as an example, which was hiring CEOs even before they would acquire the company. And those CEOs were going to be sitting on the fund's payrolls for a while till they found the company. But then the kind of returns they've generated by this strategy are phenomenal. So it really doesn't matter if the fees are high. It's a call by the investor whether they believe paying the higher fees is going to generate an outperformance by the managers, which then really makes sense or makes the fees worthwhile. Yeah, that's broadly on the execution and fund terms. And apart from these, there are a couple of other pure DD items or other due diligence aspects which are also very important, which are basically looking at the past financials. We need to look at what are the past financials. We look at the auditor's reports of the previous funds. We should also look at the quarterly management reports that would give a lot of indication on the quality of the manager, quality of the deals done in the past, quality of reporting, level of reporting, what is the level of data you will get to be able to see where the money has gone and so on and so forth. And the other important aspect is really getting into the details of the deals that have been done from the new fund where the money of the investor will go. That would be a real test of the pudding, so to say, whether it's meeting the strategy that they are promising, whether they have a value addition plan, whether it was a proprietarily sourced deal or not, and things like that. I mean, it's really the live deal that's happened recently, and you can check. And again, I mean, the investors are going to be participating in that deal. So the investors need to see whether they believe this is the right deal and has the potential to generate the returns which the manager is promising. So that's another aspect which investors need to consider while performing their due diligence. And yeah, coming on to probably one of the most important aspects as well is reference checks. Sorry. I mean, it's always great to look at the past track record, the numbers, the strategy, the team doing all the meetings and so on and so forth. But an investor would get real insights by conducting these reference checks within their network. I mean, either investors can check with other investors who've been investors in the previous funds, and that would give a sense on how the investors have been experiencing the fund manager strategy. Reference checks could also be with underlying portfolio funds. There you can get real insights on whether the fund manager has really added the value that he was mentioning in the presentation. Has the company really grown under the investment of the fund manager, and so on and so forth. So these are really important aspects where you get to know things which were not discussed in the presentation or which are not visible in the numbers. So those calls really help in formulating your view on whether the investment makes sense or not. Getting on to the next few aspects, so that's legal and tax due diligence. Of course, this is more for the lawyers and tax advisors to do, but of course, as the investment team, you need to be on top of these aspects as well. On the legal side, it needs to be ticked off that the legal structure is well established in a correct manner. The compliances of the local regulations are being met. The AML, that's anti-money laundering aspects, are also being taken care of. The entities are set up correctly. Things like these are what need to be checked. Of course, the lawyers help in these, but yeah, as I said, the investment team needs to be on top of this. And also the terms of the legal documents. So the limited partnership agreement or whatever is the binding legal document, depending on the structure, there are a couple of aspects that needs to be discussed or needs to be looked at very carefully. Things like co-investment rights, key man clause, MFN clause, side letters, and so on and so forth. I mean, when can the new fund be set up? What's the threshold when they need to, when they are allowed to set up a new fund? What are the drawdown timelines? What happens in case of a default? Also very important. Of course, very unlikely, but that's something that you need to make sure you are aware and are aligned with, because I mean, the contracts need to be completely clear and vetted. Equalization payment, GP removal clause, and so on and so forth. I mean, these are very technical terms being handled by the lawyers, but yeah, just give me a yeah, and on the tax side, very crucial, need to take care of the taxation aspects, that there is no tax leakage because of investments from different jurisdictions, or maybe a feeder structure situated elsewhere need to comply with FDI regulations and so on and so forth, whatever are the regulations of the local country, need to make sure that it's a tax efficient structure and does not lead to unnecessary leakage of tax. When investments are made in different jurisdictions, also need to take care of the withholding tax requirements of local tax filings and so on. Yeah, I mean, these are technical aspects which are well covered by professional tax advisors and lawyers, but yeah, something that we need to always take into consideration. Yeah, I mean, these are the key aspects which I thought can be covered in this period of time. And again, I mean, due diligence is not a very exciting subject with a lot of graphs and charts, but I tried to kind of make it more interesting by adding some examples from our past experience. And just to sum it up before I open it up for questions, is that the due diligence is, yeah, I mean, not so much a numbers game. Of course, there are numbers and you need to do the analysis and so on and so forth, but it's equally an art, so to say, to be able to judge whether the particular strategy and whether the management team or the fund manager that you are backing is going to deliver outperformance in future. I mean, looking at past numbers, it's okay, but yeah, I mean, you should be convinced and you should be able to make that analysis and that judgment, which has a lot of softer aspects than the quantitative aspects, to be able to make up your mind whether this is the right strategy and the team which will deliver outperformance in future. And that's the crucial part of the diligence. Yeah, maybe I'll stop there. I mean, we are also broadly running out of time, so we open it up for questions from the audience, if that's fine.
Thanks, Abhishek. Audience, we've got exactly 10 minutes before we move into the next session now, because we have back-to-back sessions for the next couple of hours. So if you have any questions, please quickly use the ask a question tab and put in your questions for Abhishek. I'll be happy to take them on your behalf. Okay. So Abhishek, here's the first question. What are
Okay.
the leading tools, data sources which you use for such assessments and due diligence, especially for funds in the Indian context?
Yeah, that's a great question. So yeah, I mean, in terms of data tools, the standard databases which are available in the market, like Preqin, PitchBook, and so on, which are essentially data aggregators, which are collecting data from a variety of sources, right from public sources to the filings, and so on and so forth. Those are the ones that we use for our preliminary screening. We wouldn't rely 100% on that, but yeah, that's something that we use for a preliminary screening, just to shortlist or figure out the top performing managers, so to say. And then we have our another analytical tool which helps us in slicing and dicing the data, comparing it with other fund managers across the world, across strategies, comparing it with the PME indices and so on and so forth. So that's more like an analytical tool. It's not a database. It's a tool where we input the data of past performance received from the fund manager, which we are evaluating. So all that data goes in as an input, and then the analytical tool helps us in doing the analysis which we want to perform, usually on the funds that we are evaluating. So that's more like an analytical DD tool that we use. I hope that answers the question. Yeah. Yeah, okay. I think, Aditya, it seems that the session was either too boring or too clear, that there are no more questions. I mean, I'm happy to end or maybe wait a minute or so.
No, Abhishek, just hold on, because
Okay.
the questions might just come in. So we have a
Okay.
few minutes more, so just give
Oh,
me.
sure.
So
Okay.
guys, if you
Okay.
have any questions for Abhishek, please quickly put in. So till we get another question, Abhishek, would you like to share any anecdote or experience where like a kind of a mistake where you made in similar due diligence that we were discussing, somewhere where
Yeah. Yeah.
you kind of really found it difficult or failed to
Yeah. 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 That's a good idea. I mean, I would maybe take one negative example and one maybe a positive surprise kind of an example. Let me start with the negative one. So this was 2018, economy doing quite well, things in US and Europe also going quite well, and we were evaluating a fund manager in Europe, which was going to be investing in industrial and machinery related segment. So that's a very capital intensive segment. And at that point in time, that segment was doing quite well. And we estimated that this will continue to do well. And one issue that we had, or one DD aspect which we kind of spotted, but we were not very negative about it, was that they were having a very concentrated portfolio. So the previous funds, fund one had, I think, 4 investments, and then fund two had 5 investments. And they said that they would reduce the concentration and increase the size of the number of investments in the new fund, which we thought was fine. I mean, because essentially they were building platforms and were planning to do a lot of add-ons and so on. So we were weighing whether it's okay to take that concentration risk and also to take that sector risk, saying that these are going to be investing only in industrials or machinery automation focused companies. Probably at that point we thought, yeah, that was a good decision, and that segment will do well because of automation and so on and so forth, capital being easily available. But yeah, that's not turned out very well in the past 2 or 3 years, and that's been really badly hit by COVID, because yeah, people are not setting up new factories, challenges on travel and so on and so forth has really added to the woes. So that's one thing we kind of learned, that yeah, diversification across a couple of assets is really important. And yeah, maybe one positive example is, I don't know, I get back to this fund again, which I said was looking at hiring the CEOs first. And so this was one aspect which we liked, but there were a couple of other aspects which we did not like. So one was they had a very thin investment team. So they had 5 partners, 2 vice presidents, and 2 or 3 analysts. That's about it in the investment team. And we are like, this is a $1 billion fund going to do mid-segment buyouts. They are going to be heavily involved. Of course, they had the CEOs and they had other teams, operating professionals team, and so on and so forth. But we were really concerned about the thinness of the investment team. But yeah, I think, the other aspects of the fund were so compelling that we went ahead with the investment, and that fund is doing quite well. And yeah, I think so some of these aspects turn out to be well, and sometimes some of these aspects don't fall in your favor. But yeah, that's how we learn from our experiences, and we take that ahead in this complicated DD scenario.
So Abhishek, next question is, for new companies, all the elaborate financials may not be available in public domain. So how do you evaluate them?
Yeah, I think, for us, it's more how we look at the fund managers. But again, I mean, if you are looking, going one step down from a fund manager's point of view, when they are evaluating new companies which does not have elaborate past financials, then again, they are looking at what is the potential of that company, what is their growth plan, or what is their growth strategy. Does the product or the service that they are offering to their customers make sense in this current environment? And does the fund manager believe that the promoter has the capability to scale that product or scale that service and that business in the next 5 years? And based on those assumptions and their understanding of the market and business, it's an investment call. You're right. I mean, if it's a fairly new company or a startup for that matter, it's very difficult. There's not much of past financials, and whatever is there is not really relevant. I mean, the scale is so small that you need to have the vision to see the company's growth 5 years down. And if you believe in that, then the investment is merited in a company like that.
So the next question, and I'll have to keep it the last one, guys, because of shortage of time. So Abhishek, how are PE firms adapting automation on the ground currently, like for your operations or assessment of portfolio companies, uh, probably monitoring portfolio companies? So how are you using automation, or how are you adapting to automation?
Yeah. That's a good question. I'll probably take it in two parts. So at our level, at the investor level, we are seeing a lot of automation in terms of the analytical tool that I mentioned. Essentially, what that tool does is that they are collecting cash flow data from a huge number of funds across the world. And of course, that's not available on a named basis. That's just the database or the input that goes into the system. And when we put in our data of the fund manager, which we are evaluating, then that analytical tool kind of easily helps us in the analytics, comparing it with listed equities, checking the standard deviation as compared with the market returns, how much of the returns in the past have been purely due to improvement in the market, how much of that has been due to improvement in revenue, and so on and so forth. So that's something that we use, and we are using other simple tools like the CRMs for tracking our deal flow and so on and so forth, which is not something revolutionary, but yeah, that's probably a need to have for everybody in days like these. And I think on the underlying fund managers, I think the fund managers are also using a lot of systems in-house in terms of sourcing their deals. So, I mean, just to take an example quickly, maybe in a minute I'll sum it up. We were discussing with a fund, early stage fund. So what they've built is they've built a sourcing engine, which is, of course, checking what deals are happening on Crunchbase and all these other websites which are mentioning about deals. But they also have an AI tool which is tracking which entrepreneur is tweeting what on his tweet handle. So depending on what they are tweeting, the AI tool kind of judges that maybe this guy is building his next venture, or he has a product in mind, and that's the time to go and approach that entrepreneur before any other VC fund approaches them. So we are seeing all sorts of things in the market. Of course, I mean, it needs to be seen how successful that tool is, but definitely AI and technology is going to play a massive role in all industries, including private equity and including investments going forward.
Great, Abhishek. So I will, guys, will have to wind up the session. Our next speaker, Rahul, is already here. Abhishek, on behalf of the entire AIWM and IWF community, as well as the participants and those who want to watch the video, I thank you for your time and efforts. And I also thank Karan Bandari for your colleague who's been, helping us with this entire presentation part. So look forward to keep engaging with you more on such sessions, Abhishek. Thank you so much.
Absolutely. My pleasure. Thanks, Aditya, and thanks the entire team and the audience. Have a good evening. Bye.
Thanks. So welcome, Rahul. We'll just take a couple of minutes break before we dive into your session on.
Sure, please take your time.
So just quickly grab a cup of tea if you want, and we can get.
Sure. No worries.
All right, Rahul. So can we start?
Hey, good evening.
Hey,
Yes,
hi.
most certainly. Most
You,
certainly.
do you have any presentation that you'd like to share?
Yes, I shall share the screen with you.
Yeah, just
I need some
before.
rights to do so. Great. So are you guys able to see this?
Yeah, Rahul, we are able to see it. So before I start quickly, so we are conducting the speaker sessions on Zoom, and the audience is watching it live through the virtual event platform,
Okay.
Virtual X. So audience, you already know the entire process by now, and those who are joining who joined in recently. You can watch the session live, and once Rahul is done speaking, if you have any questions, you there is a ask a question tab on your screen. You can put your question through that, and I'll be happy to ask those questions on your behalf. In the speaker name, please mention the speaker's name. I see a lot of candidates mentioning their own name and or something like current speaker. But in this platform, it is the questions are getting mixed up. So just mention the speaker's name so that it comes out properly to me, and I'll be able to cover all your questions in time. So Rahul, we have an hour or so.
Sure.
My request to you will be, let's say we have a talk of around 30, 35, 40 minutes, and we can have around 15 to 20 minutes at the end for some kind of a Q&A if audience wants.
Sure. Sure.
Yeah.
We'll do that.
So before handing over the mic to you, audience, let me take this opportunity to quickly introduce Rahul Parmar to all of you. Rahul is a seasoned professional with over 19 years of experience in retail banking and private wealth management. He's currently heading the family office and investment function at ICICI Securities Private Wealth Management. Uh, Rahul, after completing his PGDBM from Symbiosis Institute of Management Studies, began his banking career at Citibank, where he was responsible for driving the retail banking initiative on wealth management and insurance business in Pune. Taking a liking to wealth management, he moved into HNI and UHNI banking and wealth management platform with HSBC, where he spent 6 years in managing some of the largest clients of HSBC while also heading their branch. At this stage, he realized the potential for good wealth management practice delivered through great franchisee and thus began his stint with the ICICI Securities Private Wealth Management, where he was instrumental in creating a large and enviable team for Maharashtra and Goa. Uh, as I mentioned, now he's heading the family office and investment function, and that needless to add, basically uh, gives him the access with the top-notch investors, families as well as private investors from the country. And this session, we designed it to get a wealth manager's perspective of how HNIs are taking up to AIFs, and how what kind of strategies and what kind of roles a wealth manager or a multifamily offices that AIFs can play in a HNI portfolio. So on this note, Rahul, I'll hand it over to you, and we are eagerly looking forward to your session and sharing your perspectives from a wealth manager's point of view. All our sessions so far have been more on the AIF part, whether it's on the compliance, fund management, or legal aspects of it. This particular session, we are looking to know the AIFs bit from a wealth manager's perspective. So
Sure.
over to you.
Sure. So thank you so much. Thanks, Aditya, for the introduction. Very kind of you. Very, very glad to be on this forum and speaking to this audience. And I would put this time to good use in being able to convey a wealth manager's side of how we should look at AIF as a tool in creating sustainable high delivery portfolio for our customers. So I'll take you through some part of how AIFs came into being, and we'll take it up from there. So a very quick introduction to what AIF is, although I'm very sure the audience here knows well. But just to set good order, it's basically privately pooling, of investments under a vehicle, where most of the investors come together with a common investment outlook. The way AIFs are structured in our country, any company, corporate body, trust, or limited liability partnership can, avail the AIF license. And it is basically regulated under the AIF regulation of 2012. So, the mutual fund order of SEBI or, collective investment regulation of 99 does not cover this. There is a separate act which basically governs how an AIF must operate. Very few exemptions are given, and these include, family trusts, employee welfare trusts, gratuity trusts, and holding companies, which do not require the licensing of AIF. Otherwise, to run portfolios in pooled format, you require to avail either the AIF license or any product which you deem relevant to run your vehicle. So, in simple terms, it is basically a pool of investors who come together with a common objective to invest in various asset classes. So, the good part about AIF is it could be anything. It could be stocks, it could be debt, it could be private equity, venture capital, real estate, any asset class that you feel you want to participate in, and there is a AIF registered and providing that service, you can participate in it. As of today, more than 550 AIFs are registered with SEBI, and this number is growing bigger each day. It will help to just cover this roadmap of development of AIFs, how they came about. It sets a good order on, what are the events, what are the investor inputs that led to creation of AIF. So from 1996, where the VCF regulations came in, it led to a concept paper which was proposed in 2011, and subsequently in 2012 the AIF regulation took shape. Now, the AIF regulation basically encompassed all the entire process on which AIFs are built, the entire journey of investments and regulations therein. These rules were extended to basically include angel investment, private equity, and down the line in 2014. Some very material changes were made to the AIF structure, which were pro-investor, which said that the AIF needs to seek an approval from at least 75% of the investors for bringing about any material change. Material change includes, change in ownership of the AIF vehicle, if the company changes, or changes in charging structure, or changes in lock-in period. Any material change to the AIF has to be implemented only post 75% of the investors approving the same. So, SEBI kept on realizing the way they will protect the investors' interest, and they kept bringing in those changes regularly. In 2015, the FDI automatic route was opened up. So 100% FDI in AIF structure. In 2016, some rules were relaxed for angel investments. So the reason why it was done, angel investment funds used to be very small in size, considering small tranches of investments in new opportunities. Hence, the value of investment was brought down from 50 lakhs to 25 lakhs. That was one major change for broader participation. And the second ruling that came in was from 49 investors previously allowed. The number of investors in an angel AIF were brought up to 200. Now, this number for any regular AIF apart from angel funds is 1,000 investors. Now, in 2017, CAT3 AIF were permitted to invest in commodity derivatives. So started the journey of AIFs in commodity space also. And the online registration platform for AIF was introduced. In 2018, guidelines were issued for AIF and IFSC. So, Gift City is one such IFSC, which can now, avail benefit of registering AIFs and fund managers and overseas companies. Brings in a lot of SOPs when it comes to taxation, procedure, pricing, all of that, and of course, infrastructure. Now, in 2020-21, SEBI has brought in a mandate, which basically now asks AIFs to benchmark themselves. Up until now, there was no benchmark available. There still isn't. They will have to come up with one. But SEBI has already initiated this to be done. A very good move, very welcome move for investors, because it is going to bring in, a lot of, structural growth to this segment. When investors see returns benchmark to what the industry makes or what similar fund managers are doing, they will actually have better grasp and hold on how their investments are doing. And of course, the rationalization of this requirement means that every quarter they have to report the performances to SEBI. Taking you through, a quick structure on AIFs. They are categorized into three broad categories, 1, 2, and 3. This is chosen at the time of registration. A lot is to do with the underlying investment. So category 1 typically is, an early startup venture capital or a social venture kind of a fund. Invest in socially economically desirable areas, so infrastructure, SME funding, all of those come under the category 1. Category 2 basically looks at private equity, debt, real estate. This is also the biggest category of AIFs today in the country, AUM wise, commitment AUM wise. And there is category 3, which looks at, in equities, pipe, hedge funds, all of those. Now, the basic difference in this categorization is number 1, taxation. So while category 1 and category 2 are pass through, which means the tax implication is in the hand of the investors. There is no entity level tax on the AIF. Category 3, however, pays the taxation at entity level, at the AIF level. The taxation here depends on the underlying security, underlying investment. So the rules governing that particular security would be the guiding factors for taxation. So example, for equity, it will be, long term at 10, short term is 15. For debt, it'll be 30 plus, and, or 20% post indexation after 3 years, so on and so forth. So what matters is, what does the AIF fund invest in? Now, some of the features that you will see, basically all AIFs in Cat 1 and Cat 2 are closed-ended with minimum 3 years of tenure. Leverage is strictly not allowed in both Cat 1 and Cat 2. In Cat 2, leverage to operate on a daily basis is the only permissible quantum. Otherwise, no leverage on the portfolio for investment is allowed. The maximum cap for single portfolio entity is high at 25%, which proves to be a very important factor when it comes to investing in AIFs, which I will discuss a little later. Category 3 can be open or closed-ended, and they are allowed leverage to the extent of 2x. And the maximum cap here is restricted to 10% in a single portfolio entity. This is basically the difference between Cat 1, Cat 2, and Cat 3. If I am to look at numbers or, how the category shapes up against, say, mutual funds, PMS, these are the numbers. So if you look at mutual funds, almost 31 lakh crore in assets, PMS, 19 lakh crore, AIFs about 4.41 lakh crore, 4.42 in commitments. So it is represented in the graph as well. So if you see category wise, these are the commitments in Cat 1, Cat 2, and Cat 3 AIFs until December 2020. I think this is the date of which this data has been captured. So in Cat 1, 42,353 crores of investments, 3,52,000 crore roughly in Cat 2, and Cat 3 about 46,825 crores. These are on committed basis. So since AIFs have a drawdown period, this figure refers to the committed value by investors. So if I am to put that in numbers pertaining to growth CAGR over 5 years, so the way you've got to read this is the graph on the left-hand side top talks about the 5-year CAGR growth category wise. So if you see category 1, the commitments have grown 34%. For Cat 2, it's 85%. And for Cat 3, it's 59%. And AIF as a whole has been growing at a CAGR of 70% when it comes to the committed value. So clearly a lot of new AIFs are coming on the scene and they are in demand. So they are lapping up a fair chunk of the investor commitment. This is visible in this particular graph. If you move on to the graph on the right, it quantifies these commitments in value terms. These are in 1,000 crores. So typically funds raised versus investment made. So about 2,13,000 crores have been raised in AIF overall, out of which 1,84,000 crore has been deployed till now. So these are the numbers and they stack fairly well. If you are to read into this data, if you look at the graphs below, let me start with the Cat 1 commitments graph on the left-hand side. You will see the breakup of where has this money come. This information is available for Cat 1 and hence I'm sharing. It gives you a flavor of, where is the pull coming from. So clearly you can see, 64% of the commitments are in the VC category, the venture capital category, which has by far seen the biggest pull. SME remains fairly low at 28. Social venture, basically not-for-profit philanthropic investments have seen a very, very large allocation in 37%, greater than SME. And infra has seen a small 11%, but it has now been growing fairly well. So expect this infra category to swell, in the near future. The fund raised again shows same picture. So, venture capital has seen bulk of the fundraisers at about 62%. Social venture not too bad at all at 39, where SME is showing a degrowth. So basically not an area of choice for investors because of the volatility that has persisted over the last, a couple of years in the SME segment. Infra, like I said, is seeing a renewed focus. So, a fairly large, amount of fund raised in this category of late. Even in the investments made, you can see these similar, similar percentages. So you're very clearly able to distinguish what opportunities are seeing more interest from investors and fund managers alike. So some key takeaway from what we've seen till now. Some of the areas where AIFs provide you with benefits is basically access to multiple strategies. So unlike the conventional investment options in mutual fund or stock investment or debt investment, where you have to typically choose within the same basket of product, AIFs can have multiple ways to take exposure into each one of these. So debt could be real estate debt, it could be SME lending, it could be government bonds in portfolio basket, it could be anything. Equities could mean unlisted, listed. Within unlisted, it could mean startups or venture capital. It could mean social ventures and all of that. So basically, if there is a strategy which you think you want to take exposure into and it is not available in the conventional space, or at least no information about it is available, you are likely to find it in the AIF space. And that's how it gives you access to multiple strategies. Flexibility, simply put, you have, since AIFs are basically targeted at experienced investors. So investors who know the risks associated with investing in multiple assets, multiple strategies, and are able to safeguard their own interest by doing a deep study into what they are getting into. And hence, the entry barrier for such investments have been kept high at about 1 crore. But it also takes care of the flexibility by allowing a drawdown period. So it is one of the only products in the industry which allows for a drawdown structure, which simply means one can commit a much larger amount for investment, but start with tranches as demanded by the fund manager over a period of time prescribed in the offer document. They also provide you the ability to take leverage, which is a good thing when things go in your favor, and it can turn against you when a call goes wrong. And hence, while it is a flexibility, it is really up to the skill of the fund manager to make it into a plus and not a minus. They also have very, very focused strategies. So unlike the vast array of investments in say the stock market, where you have to choose your own stocks or create your own basket, here typically you will have very reputed fund managers creating focused strategies. So somebody can come and create a small and micro cap strategy where you can take exposure to that strategy. The fund manager would probably be well poised to pick up great buys in the entire segment and can give you both diversification and also benefit of a broader run up in the segment itself. Now, one way where this flexibility comes into good use here is if you take the example of a mutual fund. Say a mutual fund which is say 3,000 crore in AUM. If that fund decides to invest in a micro cap, which is 500 to 1,000 crore in market cap, it may not be able to do so without owning a fairly large chunk of that company, and hence that stock will become illiquid for this mutual fund. And hence, it makes sense to get into such strategies through an AIF structure. The fund size is small, the number of investors are smaller, and they are able to not just take these exposures, but hold on to them even on the way up, because the single instrument exposure is fairly high, from 10 to 25%. And hence that flexibility comes into use here. The minimum investment cap for AIF, like I said, is 1 crore. In case of angel funds, it's 25 lakh. And the maximum number of investors are 1,000. And that's 200 in the angel fund as discussed. Hence, it also creates an environment where like-minded investors come together and invest in a scheme, which is usually a time-bound fundraise. So that becomes, a plus for, what the investors look at. A short comparison between AIF, MF, and PMS, very self-explanatory. Both AIF and MF are through the pooled route, whereas PMS is non-pooled. It's in individual DMATs. There is a clear differentiation in the minimum ticket size. When it comes to MF, it's more a mass product for all investors. It encourages new investors to join, since the entry barrier is just 500 rupees. PMS, the minimum ticket becomes 50 lakhs to only attract investors with, more experience and who are able to allocate, meaningful sums for a higher risk appetite that they enjoy. The same, in AIF is 1 crore as previously discussed. MF is categorized as per SEBI circular, and PMS can be discretionary or non-discretionary depending on what the client wants, and AIF categories have been discussed. In both MF and PMS, you do not have the option to leverage, but in AIF, Cat 3, you can leverage 2x on the amount invested. Some more comparison, customization in both MF and AIF is not possible. However, AIF usually customizes on the basis of the schemes it rolls out. So one AIF provider can have multiple schemes which are customized individually, much like the categorization of MF. PMS, of course, it is possible to customize. One more aspect in AIF which you must be aware of: it is the only category of product which requires the fund manager or the company to have skin in the game. So if you run a Cat 1 or 2 AIF, you are to contribute 2.5% or 5 crore, whichever is lesser, into your own fund. Similarly, if you decide to run a Cat 3 AIF, you will have to invest 5% or 10 crore, whichever is lower. This basically brings skin in the game. It reassures the investor that the fund manager is willing to put his money on his own ability and his company's ability to manage it for them. So basically, if we look at it as a whole, it combines the flexibility of PMS and the operational ease of a mutual fund, since it's a pooled investment, so no tight constraints, and you can operate it in one single account, unlike a PMS. So as an investor, it's very important to consider these while you're investing in AIF. So on the strategy, it is very important to identify not all AIFs are same. They have multiple strategies which they cater to. Some of them are riskier than the others. Example, there is a category of investment under AIF which is called long short, which also can create losses. It does fairly well in a volatile environment, but still has higher risk because it takes exposure to options. So one has to be very careful. Sometimes, investment in debt can be construed as safe, but if you're investing in real estate, the risk is very distinct. It has to be looked at very differently from a regular debt in a mutual fund product. Hence, whenever you're choosing a strategy in AIF, you have to be very mindful that each strategy is crafted to serve a specific purpose, and it is probably suitable to a certain type of investors, and hence it's not a one size fits all. So must consider and go through the strategy of the AIF in detail before committing to it. Costs can also be a deterrent, although the sector it caters to is one which is aware of what it takes to invest into an AIF, but still, in the absence of any limits defined, like in mutual fund, you have a total expense ratio defined. In PMS, there are some caps as well. In AIF, you can charge, as per your structuring. Of course, in order to be competitive, you have to benchmark it to what is available in the market. But in short, you can structure it any way. When I say you, it means the fund management company or the fund manager decides how they want to charge an investor. It could be a fixed charge. It could be, a fixed charge plus, profit share. It could be only profit share. It could be a high watermark kind of a structure. All of these are followed, and depending on which, which fund manager or depending on which company you invest with, these structures may differ. One thing is for sure, these costs are higher than investing in mutual funds or buying stocks on your own. Taxation we've spoken of. Only thing I would like to point is in certain cases, in certain AIFs, you end up paying tax as an investor, even if the AIF, pays you out only a part of those profits. I'll give you an example. If you have invested in a debt fund, and the fund receives say 5 lakh rupees as interest, it distributes only 3 lakhs to you and retains the 2 for further investment. You will have to pay tax on the remainder 2 also. So sometimes taxation, depending on the underlying security in AIF, could be higher than your individual tax rate. It is very rare, but it can happen. Some of the prominent names, and some of these I saw as speakers also, not in this slide, but later. So on the venture capital side, you have Oreos, Zodius, Bloom Ventures, K Capital, Infra, Piramal, L&T, Edelweiss. In Cat 2, very, very renowned, well-known names, private equity, IPO, pre-IPO, structured credit. And in Cat 3, some of the big names, some very remarkable performances as well. So, I will, for the sake of everyone on this call, I will take you through some of the questions which I've preempted. These are typically common for most people. So the first one being, why invest in closed-ended AIFs when there are open-ended avenues like MF, PMS? So usually from a wealth manager perspective, whether you invest in a closed-ended or an open-ended structure is more incidental to your strategy. So the more appropriate thing here to do is select an asset allocation strategy, see if the AIF is a fitment in that strategy, see if it fits your risk appetite and your timelines and your requirements for liquidity. And if it ticks all those boxes and it is something which your wealth advisor also recommends, then I think closed-ended or open-ended is just a matter of whether it fits your investment profile or not. It has no bearing on any other aspect of investment. How much of one's portfolio should one invest in AIF? This gets asked fairly regularly. And there is no answer to this except that please follow asset allocation guidelines at all time. If you're investing in a particular asset class and you're not going above the prescribed limit in discussion either with your wealth advisor or as per your own plan, then it is okay to top up and buy new AIFs. Always be guided by the basic principles of investment, which is asset allocation and liquidity analysis. So that also becomes a key. Which are the AIF product categories should one consider at this juncture? So this question gets asked all the time, and the answer to this is slightly tricky. I would say no two investors are alike. So this category was made to be specific, and it was made to be bespoke for people who want to consider the underlying investment. So this is not a one size fits all category of product. Hence, to different investors, different strategies and categories would appeal. You must, have a fairly detailed chat with your wealth advisor, investment advisor to figure out what suits you more. It will depend on your risk appetite, your time horizon, liquidity requirements, and hence there is no specific category for recommendation. It really depends upon who you are as an investor. Taxation gets asked often. I've already discussed it with you. How it is different from MF and PMS. MF gets taxed on the value comparison on the date of investment and redemption in case of equity. And in case of debt, it depends on the income that it generates from the time you invest to the time you redeem. It may be in the form of dividend or capital gains. So debt MF follow debt taxation, equity MF follow equity taxation. PMS follows taxation advice as per the trading of underlying securities in your own demat, whereas AIF are mostly pass through. So Cat 1, Cat 2 pass through in your hands. They are clubbed to your income once you receive it. And Cat 3 follows the taxation of the underlying security, whatever it is. Lastly, are there any risks associated with investments in AIF? The answer is, of course, yes. AIF is just a vehicle. The underlying investments are subject to the exact same risk, or in some cases, even more riskier because of their non-availability in public domain or easy trade in the public domain. Hence, you should ascertain the risks of investing in any particular AIF at any given point in time very, very carefully. It should not be construed as all AIFs have the same risk appetite. No. Some AIFs are inherently more risky than the others, and hence special attention should be given to ascertaining your own risk appetite and correlating it to the ones that exist in the AIF. I would very strongly recommend, encourage investors to have discussions with their advisors before taking a call on any AIF. So, with that, I conclude my part of the session. I would be very happy to take any questions that you may have.
Yeah, Rahul, are you done with the?
Yes, yes.
Okay. Guys, if you have any questions, please post. Just a sec. Okay, Rahul, the first question for you. Given the long gestation period of closed-ended AIFs, category 1 and 2, when does one typically start monitoring performance of an AIF? Or in other words, after how many years does a performance metric of AIF really useful?
Sure. So, good question. I would say it really depends on the underlying asset. Same rules apply as the underlying asset. So if you consider investing in a debt option in a mutual fund, you usually tend to look at a 3-year time horizon, when you invest. The same benchmark should be kept for an AIF, which is investing in debt. If you look at an equity investment option, say a listed equity, then again, you should consider that the equity cycle is typically long. An equity investor should always keep a 3 to 5 year horizon in mind whenever they consider investing in equities. However, having said which, you must regularly track the performance of your AIF, because nobody commits a back-ended or front-ended performance. It is with a view that there will be a growth over a period of your investment, and hence it is important to keep a tab on all your AIF investments. I think there's a quarterly report that you receive. You must read through it, and it is always good to keep a tab on how your investments are performing. I hope I've been able to answer that.
So the next question, the benchmarking guidelines which SEBI came out with recently, is it applicable now? Where can we see such benchmarking disclosure as an investor?
Yeah. So I think it's under development. There is no benchmarking readily available. I think the industry is developing it, and I think they will come out with a solution soon. Because unlike mutual funds, which have been defined by SEBI, the classification, and there exists multiple benchmarks for them to be tracked. AIF, the same AIF can be investing across all market caps by definition, and hence it is very difficult to benchmark it to an existing benchmark. We will need to create benchmarks for AIF as an industry, ones which follow a pattern, maybe quick to adapt a benchmark, but ones where there is no fixed pattern, we might have to develop new benchmarks.
Okay, the next question for you. Do you think AIF would be available to small ticket and size investors in the near future, like mutual fund or retail investor with a slightly higher risk profile?
So considering how SEBI has moved on PMS, where the minimum ticket has been going up, I do not foresee reduction in AIF subscription anytime soon. I think the category is still new. It takes a fair bit of skill to identify this category, and the regulator would like to protect the interest of smaller investors at this point in time, who are not all that experienced in investing. So the answer is, I do not see this happening anytime soon.
In next question, Rahul, in your experience handling, family offices, where do you see more inclination as far as family offices is concerned in terms of AIF categories, Cat 1, Cat 2, or Cat 3?
So, frankly, family offices are not fixated on the idea of AIF alone. They are really agnostic to the vehicle as long as you can get across a great idea. But again, there is a very, very strict adherence to asset allocation in most family offices. And hence, when they consider one asset class, say debt, they would like to weigh all options that are available currently in the debt, which may include AIFs as well. Having said that, even if you look at equity, at any given point in time, you will have multiple options, vehicles of investment into equity, which may include AIF. The reason why AIF are gaining popularity amongst family offices, they find significance in being able to invest with similar-minded investors and not being subjected to the pitfalls of mass redemption or also over diversification. So I would say AIF becomes a product of choice because of the differentiation, and the ultimate decision is basis the allocation and the investment strategy.
Right. Moving on to the next question. Okay, so audience, I see some questions which are more apt for a lawyer or a fund manager, so I'm skipping those. If you feel there's some questions which are more suited for someone like Rahul, please post. We have another 5 minutes to go for the session to end. Rahul, any particular sectors where you're seeing a lot of interest from HNI families and family office?
So, the usual suspects of infra, pharma, they're gaining pace. A lot of demand is coming in to see AIFs that are investing into great infra stories of the future. Pharma is seeing a lot of push as well from the investor community. So these are the two stories that are playing out well. On the debt side, we're seeing more and more demand for high yield assets, yet highly rated. So there are two different school of thoughts there. The obvious answer is that yields come with risk, but given the happenings in the market over the last couple of years, most investors are turning a little risk averse when it comes to debt, and hence they look at great quality that comes with a fairly decent yield.
So other than AIFs, are there any other alternative asset classes where you're seeing a lot of traction?
I think it's a pretty standardized list, and when the markets are good, like they have been in the recent times, people tend to look at multiple options. So we are seeing a lot happening in the unlisted space. I'm sure all of you read the valuation stories in the papers every day, and that is emerging as a very strong theme. Even without the AIF structure, there is a lot of demand for investing in the unlisted space at the moment.
Sure. So, audience, any more questions? Yeah, just a sec. What is the level of transparency in cost structures by AIFs? Rahul?
So you're free to choose an AIF basis their declaration on the charging structure, and of course the AIF is bound to show utmost transparency in the way they are charging you as against what they made you sign in the commitment sheet, and that holds good. So you will see a complete statement breakdown of all costs charged to you fairly transparently, and it is up to you to choose a cost structure or not.
Super. So, I believe that's about it. Just last question. Yeah. On which category is the maximum inquiry coming from investors? Is it in search of something new, or is it diversification? What are your process to onboard a client to know that they are AIF investing ready?
Okay. So, like I mentioned in my talk, AIF is just a vehicle. You have to be ready to invest in the underlying security. So, AIF in itself is not the investment asset. It is either equity or debt or private equity or venture capital or any of that. So, I think you must have the time horizon. You must have the risk appetite, and you must have the ability to not have liquidity, for the lock-in period of the fund. I think that's a primary qualification. As respect to the first part of your question, which category or which theme is in demand? Um, I would say, it keeps changing. The market is dynamic, and there are themes which do well. And as soon as a particular segment does well, we usually see interest in investors to check if there is a AIF that caters to that segment of growth. But in today's times, the market cycles have shortened considerably. Hence, you should only choose sustainable growth stories to create an AIF. Otherwise, for all in a short period of 3 to 6 months, the growth story is out, and you're sitting on a portfolio that does not do well for you going further. So it's tricky. Best left up to the fund managers to decide, and for us to choose as investors what we want to commit.
Super. So on that note, Rahul, I think we'll have to wind up the session. We have our next speakers already with us here, and
Great.
but thank you so much. I know between you and me, it was like a stretch to get you here for the session. Next time, I'm hoping to give you more and better advance notice.
Would
for
love
joining
to.
us for
Would
such.
love to.
But thank
I
you so
hope
much.
this session has been helpful. Thank you, everyone. Thank you.
Yes, yes.
Glad I could come here. And
it was, and looking forward to having you with us for more such sessions. Thank you so much.
excellent. That'll be my pleasure.
Stay
Thank
safe.
you so much.
So audience, our next session starts at 7. So we'll take a quick few minutes break and dive in straight away into the next session, which talks about opportunities in real estate private equity. So see you all in another 5 minutes. Yeah, Sushant, so can we get started? Hello. Sushant, can you hear me?
Hi, good afternoon. Yes, I can hear you.
Hi. Is Mr. Balaji Rao also joining us right away?
So he joining us, but he will join in about 30 minutes. So the idea is I will take through the presentation, and I'll try to wrap up in about 20-25 minutes. The idea is we thought we'll keep it more interactive.
No, of course, of course. So we are live right now. I mean, the audience is already there,
Sure.
with us on the platform.
Right.
I hope Mr. Rao joins here on the Zoom link after 20
Yes.
minutes, so I can then
Correct.
make him also the co-host, and he can take it up.
Sure.
So great. So audience, we are getting into the last session, last masterclass. Last session for the day and last masterclass of this entire event, because tomorrow we start with our regular, panel discussions and other sessions of the conference. So, and this couldn't have been, this is a topic which is close to almost every Indian's heart. So, real estate, whether it's retail or whether it's institutional or whether it's, individual or through AIFs, Indians just love real estate. And I thought a subject like this to end our masterclass sessions would be quite apt. Today we have two very, very eminent speakers joining us from Axis Asset Management. Our first speaker is Mr. Sushant Pote. He's the principal real estate for Axis Asset Management. And we'll also have Mr. Balaji Rao joining us shortly, who's the managing partner for real estate team at Axis Asset Management. So Sushant, welcome on board. This our first session together for us, with you as well as with Mr. Balaji Rao. So glad to have you guys on board for this interesting summit, and we are now eagerly looking forward to your session. I'll just give you a quick heads up. While the session is live, and the audience is joining us through a separate virtual event platform. Audience who joined in just recently or just joined in for the session, you can watch the entire proceedings live, and if you have any questions for the speakers, you can there's a ask a question button. You can use that to put in questions for the speakers once they're done with the talk. I'll be happy to take those questions on your behalf to the speakers. So Sushant, we have around an hour or so, and this is last session, so it's okay if you're getting more questions and we have to stretch off it, by a few minutes. That's absolutely fine. So thank you so much again for joining in. Looking forward to the session. Over to you.
Thank you so much. Good evening, everyone. I hope I'm audible.
Yes, you are audible.
Okay, great. And I hope the screen is also visible and it's moving when I try to move.
Yes, it's working absolutely fine.
Okay, great. Thank you so much for the confirmation. Good evening, everyone. So today, what we will do is I'll take you briefly through the presentation. The idea is to give you brief overview of the industry, what are the AIF products into this, or in general private equity products into the real estate. So we will keep the presentation and the concept at the basic level. And what I would like to do, and what in fact, me and Mr. Balaji Rao would like to do, is keep this more interactive, hear out your question, and answer them to the best of our abilities. So I encourage all of you to please ask as many questions as possible. I think that is the best way, rather than having a standard presentation. So I will try to wrap this up in about 20-25 minutes, so we have enough time to discuss and take your queries. So the agenda for today is as following. I'll give a brief overview of the real estate. And in this presentation, you will notice we will focus more on the residential real estate. Then there are what are the investment opportunities into this particular space. And then one typical concept we have taken, currently, which is appropriate for given the market condition and how a private equity product has been designed and how it works in this particular segment. We'll try to explain that. So firstly, real estate, these are the broad industry stats. And just to quickly give you brief of, it's a significant, still a significant industry. So it is one of the fastest growing sectors. Many of you would tend to believe, like as any other sector, it goes through its ups and downs. But as a sector, it's still one of the significant. So in 2018, the size of this industry was 2020, the size was about 180. And it's expected to grow at a CAGR of almost 17% in next 10 odd years. Importantly, this is a second largest employer after agriculture. Then this is one of the highest contributors to the economy, and it's expected to contribute almost 13% to the GDP. And importantly, why this sector is still very much relevant, very much there. This is a traditional asset class or traditional industry, but it's there because, as we typically say, roti, kapda, and makan, that's one of the fundamental and basic needs. And it's none of the kind of technological innovation, none of the industry disruptions. It can't replace this one of the basic needs. The housing can't go away. And particularly in a country like India, still there is a huge unmet demand. So this sector is still very much relevant. And you can see in the graph the size of the industry, plus importantly, how much FDI this industry has been able to attract over a period of time. Moving on, in real estate broadly, the various segments are as following. One is residential, second is commercial or office space as we broadly call. Third is retail, which is essentially the high street retail or individual shops as we call, as well as the malls. Fourth is the industrial and logistics, which is more warehouses, data centers, etc., etc. Then there are a few other segments which are related to real estate, but exactly are not considered part, which is like hospitality and so on and so forth. But in this session, what we'll do is briefly, we'll take you through what is the status of these broad sectors currently and what is the outlook in the near future. Residential, anyway, we are going to go at depth, so we will defer the discussion on that. So importantly, office. Post-COVID, India is going to remain one of the preferred outsourcing destinations. So there is a lot of expectation that the growth, particularly in IT, ES segments will come up and the demand will increase. Secondly, the physical offices will stay and the portfolio optimization will happen through a right mix of traditional as well as flexible spaces. So currently, I think many of us are experiencing, in fact, I will say most of us are experiencing this phenomenon called as work from home. We had a couple of years back, we had never thought of this, but this definitely is going to stay. It may not be, once things normalize, it may not be one of the extremes. It may not be, back to where we were used to work completely from office. Neither is going to be completely from home. So mostly what's going to emerge is a flexible or a hybrid model. Most likely, it's time will tell how it will shape up. But that's the model perhaps most of the industry is going to follow. So flexibility is going to be critical. Then in terms of leasing volume, it's expected to pick up. The rental recovery is to happen, but nonetheless, some of the things that we have seen currently and which we are going through, which is the second wave, which has absolutely unexpected and devastating effect. How long this will sustain, whether there will be subsequent wave, obviously these factors which are having a far-reaching impact not only on this particular sector but on the overall economy. But that's something one has to be watchful of. These comments were, kind of these were made, and these are slight dated in the sense about a couple of months back, when the thought was things are, kind of now stabilizing. But obviously, since last month, everything has gone for a toss. So one needs to watch. Second is the industrial and logistics. So the e-commerce and third-party logistics, these are the biggest catalyst for change, particularly post-COVID. And there is a higher preference for longer tech-enhanced spaces, importantly more than 100,000 square feet. And the demand resilience will boost the global investor interest. And you would have seen in the newspaper in various things, there is a lot of new investment coming, particularly in the warehousing. There are AIFs which are getting launched, particularly where the theme is, the underlying investment is that of warehouses. And what they do is the tech enhancement to both supply chains as well as warehousing processes, which is the key. And overall, the leasing volume is expected to increase, and the phenomenon like COVID, the lockdown, etc. In fact, it has more accentuated the use of e-commerce and the warehousing demand. Coming to retail, this is one of the segment which is kind of heavily impacted during the COVID, but still this is one of the important segment, and the prominent stakeholders, they will remain focused on this, and they will keep on reinventing themselves, reinventing the experience. So a lot of the existing spaces, they will be realigned, and there'll be a lot of emphasis on outdoor and open spaces, because one of the, I think, key takeaways from this pandemic is, I think everywhere, in general speaking, there'll be more preference for a open spaces, enclosed spaces, be it home, be it work, be it your social interactions. Again, in this also, flexibility is going to remain the key for the success. And with the accelerated growth in e-commerce, the format of various occupiers, etc., is expected to change. So QSRs, the grocery segment, these are expected to lead the retail demand and recovery in this. And the transformation in this sector is expected to lead by the technologies that will improve the customer experience and that will allow cost optimization, so on and so forth. Now let's come to the residential, which is the, I think, one of the key segments which we are discussing in this presentation. The mid and affordable segment, that's going to remain, that's going to be the main demand driver. It will thrive, it will drive the sales. If we just look a couple of years back, and if we had looked at the millennials, I think the huge, be it around houses or be it around cars, everything, it was kind of, pay as you use. That was the philosophy. Nobody wanted to really own a house or a car. But what has happened is this pandemic, it has underlined the importance of having or owning a house, and importantly, house with a sufficient space where you will need to have flexibility for your working as well. And that's what the importantly what we have seen, particularly from September 2020 till almost March 2021. There has been huge demand. Obviously, this was led by other factors, but importantly, the configuration of houses which got sold, that's one of the key messages. And across the board, right from affordable to all segments, people have been preferring a larger format houses than a smaller format. Then with respect to the developers, the project execution and cash flow management is expected to take the center stage. The developers, they are focusing more on completing existing projects and liquidating them and selling them rather than launching new projects. So in short, work from home is going to be a long-term fact now. The pandemic has established that owning a home is better than renting an apartment. And naturally, all of us have experienced that our home has been our first line of defense against this pandemic. Let's look at closely again at residential real estate and how it's the safe harbor. So this is an interesting analysis. What we will do is let's go back almost to more than 10 years, almost 12 years back, and see how this segment has performed as an industry. Like we say, like any other industry, it goes through its ups and downs. So the graph shows essentially the prices and the pricing, how the pricing movement has been, and secondly, the number of houses which are sold. This is in the top 8 cities in India. So as you can see from the graph, perhaps this sector topped somewhere around 2011 until around 2013, it was doing fairly well. After that, the decrease in the sales or the relative decrease in the demand started. And till it kept going down till about 2017, 18, and 2019 and 20. We all hoped, there'll be a rebound. The cycle will turn, and the sales volume pick. But because of COVID, that thing has got deferred. Interestingly, 2016 to 2020, the last 4 years, this has been a very interesting period. A lot of things happened in a short span of time, starting towards the end of 2016 when the demonetization happened. Next, in 2017, two important and really phenomenal structural changes happened in the industry, which one was the implementation of RERA and second is the GST. And a couple of years down the line, in fact, the next year in 2018, there was an IL&FS crisis, which created a huge liquidity problem for the sector. So all in all, between 2016 and 2018, the sector got impacted by these 4 events, and this had so much effect, which has created, in a way, a lot of stress in this. The sales have come down. The capital flows or the liquidity has substantially come down. And that is one of the reasons why this sector has still struggling a lot to come up. However, as I was saying, around 2019-20, the expectation in general was that tide will turn, the sector will start picking up. Some of the early green shoot, or there's at least what we have seen is a sharp rebound. Again, this is one needs to see it carefully in light of the COVID, the deferred demand. So if you, from the graph, if you see the Q2 of 2020, this was heavily impacted. The sales had come down almost to very low level. Then next quarters, Q3, Q4, it has come up substantially well. Similarly, in terms of launches, there has been a healthy trend. And again, if we look at city-wise breakup, both in terms of launches and sales, Mumbai has been leading the pack, followed by Pune, Bangalore. Then in terms of sales, it has been Hyderabad, then Chennai, etc. And other important factor, I think, is the inventory also has been substantially reducing. So all in all, the last 3 odd quarters, they had been good for the residential real estate. Why this has happened? I think there are few important factors. One is the affordability. So the last 4 to 5 years, or in fact 5 to 6 years, the home prices, they had been stagnant. In fact, there have been some correction. At the same time, income of, let's say, the potential buyers, it has been increasing, whatever may be the percentage, whether it's 5% CAGR or 10% CAGR. So the affordability, which is basically a home loan payment by income ratio, the affordability has been improving. The home loan rate, they are lowest in almost last 15 years. And there is the different and the other phenomenon, right? Which a lot of people always keep debating whether to buy or to stay in a rented house. So the differential between home loan rate versus rental expense, it has come down substantially. And with the tax SOPs, etc., today it makes much more sense to buy an apartment rather than renting it out. Then the few of the other green shoots are if we look at the listed players like Prestige, Brigade, Shobha, Oberoi, they had a phenomenal quarter, which was the Q3 of FY21 or October to December quarter. The mortgage market has been moving. Most of the leading players, they have seen double-digit growth in their mortgage book. The property registration, particularly in Maharashtra, it has been substantially high. So all in all, the segment, the tide has definitely turned towards the last 3 quarters. But as I said, again, this second wave is something, and particularly the severity and the impact of it has been completely unexpected. So one needs to cautiously watch how things will turn up in next few quarters. Now that was more on the industry or real estate. Let's quickly look at what are the type of opportunities which are available. So generally speaking, there are 2 types. We broadly classify as into 2 buckets. One is personal investment avenues and second is business investment avenues. So personal investment avenues are more like the equities, the bonds, mutual funds, and fixed deposits. Typically, these are traded securities with reasonably established companies or closed-ended deposit with an institution. The returns are relatively, particularly in debt and deposits, are lower and a function of time. Mutual funds, as we have seen in the past, the returns are relatively higher and they are generated by trading. When we say trading, it's not like on a daily basis you are doing, but still what one is doing is, you are buying a particular security, holding it for some time, then selling it. That's how the return is generated. Now let's look at what we mean by business investment avenues. There are private equities or AIF or venture funds. These provide the exposure or access to business investment avenues. These are the channels through which one can take exposure to actual business, to its capital stack. In this, the returns are not generated by buying, let's say, equity stake in a particular company and selling it later. I think that is a mechanism, but importantly, you are taking exposure to the operations. You are actually monitoring, controlling, influencing the operations. You are increasing the profitability of that business, and that's a direct correlation to your returns. That's how you are generating the returns. Very simply speaking, in real estate, these are the various types of investment opportunities where you can take exposure. One of the favorite and age-old method has been holding real estate as a physical asset, where you buy land or an apartment or an office or a shop, things like that. Or you can take exposure to real estate stocks. Thirdly, there are REITs, which are again, listed, publicly traded instruments. And fourthly is real estate AIFs. And briefly comparing this, why real estate as an asset class is important. I think important thing is it has low correlation to other classes, whether it's equities or debt. So irrespective of how those things behave, real estate is going to relatively remain stable. It creates a long-term asset, and importantly, over a period of time, it's hedged against inflation. So the real estate returns in the past, what we have observed, what has been seen is the long-term return generated, they beat the inflation by a fair margin. Then there is a real estate equity, as is in the case, and there are REITs. So these provide higher equity, liquidity. It gives you partial ownership. However, there is a volatility because of the underlying nature of the equity investment. Real estate AIF, on the other side, this is a specially curated selection with selective investment opportunity. The investment could be in the form of equity, debt, or a combination, and the fund structure makes it tax effective. And this is one general to give you overview how the real estate or the reality index has performed versus Sensex. It has as on end of this slightly dated data, as on Feb 21, this has done slightly better than the BSE Sensex. The next thing that has been on the block and which has done well in last couple of years is the REIT. Very simply, all of us know, but just for the sake of completion, REIT is an avenue where you take exposure to rented spaces. It could be commercial, retail, or hospital. Importantly, these are rent generating or yield generating assets. And like a mutual fund or equity shares, these are the units which are listed, they publicly trade, so there is a liquidity. Importantly, what REIT does is it's giving you steady income, because as per the rules, REIT needs to invest more than 80% into income generating asset. More than 90% of its regular income generated, it needs to distribute. These typical asset classes, this has been high ticket size and where, away from reach of, let's say, normal investor, but REIT has made it now possible for a lot of investors to take exposure to it. Currently in India, there are 3 REITs which are there. There's an Embassy, there is a Mindspace, and then there is a Brookfield. And the performance is there to see on the listed platform. Now let's see what AIF play comes into picture. So AIF unit, it's a professional, it's managed by a professional, and there's an investment team. It's most of the places the AIFs are kind of started or managed by institutions, so there's institutional backing. And what it does is, through AIF, what you can do is you can have diversification. Like we said, in a REIT, you can take exposure to various rent generating asset which otherwise has not been possible. And what it helps is it helps in realizing intrinsic market value. And as we said earlier, there's a low correlation to other asset classes. And as we are saying, the residential real estate is on the cusp of revival. So this is a better way of taking exposure to this industry. And these are some of the stats about how the AIF has been shaping. So I think 2012 is when the AIF's rules were floated. AIFs started coming into picture. To begin with, and if we look particularly at the amount of fund raised in CAT2 AIF, in December 13, it was just about 469. As on December 20, the number stands at 1,48,000. So they have grown by more than 300 times in terms of fund size and more than 100 times in terms of investment. Moving on, I think let's quickly look at the last mile funding. This we wanted to share as a interesting concept, which is there in the market, and just to showcase how AIFs can opportunistically design a product and how one can take benefit of it. So this is a typical simple depiction of residential real estate life cycle. Broadly, we are saying there are 4 or 5 stages. There's a land acquisition, there's approval, there's a construction stage, and then there is a completion. And as the project progresses, the risks associated and the cost of capital associated comes down. So it's at 18% plus to begin with, and it keeps coming down at, say, about 12 to 14 at construction stage and almost 10 to 12% as a completed stage. But currently, as we saw in the previous slide, because of the stress created, because of the liquidity crunch, there is an opportunity at this late stage where you can still make significant returns. And why this has happened? So this is data from LASES for us. And importantly, if we look at, and this is slightly dated, but still relevant, if you look at the number of units as on September 2020, there are almost 932,000 units. And this has been classified under various buckets of ticket size. And the lowest category, which is what we call is affordable, which is up to about 50 lakh. That's the one where a lot of attention and a lot of incentive from government have been given. But if you look at the by percentage of the value of this segment, it's about just about 21%. While the next four odd categories, that is ticket size from 50 lakh to almost 4 crore, that constitutes almost 60% of the stock. And this is a segment which is in the dire need of funding, and this is the opportunity. And various agencies have tried to estimate the size. So the Swami Fund, which is created by government, they have said the size of this opportunity is about 55,000 crores. There are almost 4.5 lakh stuck units. Prop equity, on the other hand, it estimates the number of units as almost 7.4 lakh, and the size of the opportunity as 90,000. And there have been various funds in the market who are trying to take advantage of this and deploy products which will help in the last mile funding. Now, let's quickly take a look at what Swami is trying to do. So Swami stands for Special Window for Completion of Construction of Affordable and Mid-Income Housing Projects. This is an initiative backed by government to provide last mile funding. The SBI Cap Ventures is the investment manager here. The total fund size is about 25,000 crore, but the first close which they had is about 10,850 crores. And this fund had a phenomenal deployment track record. So, within a short period of time, which is almost 9 to 10 months, they have sanctioned about 123 projects worth 12,000 crores. And the final approval is given for 33 projects, and they had committed almost 4,200 crores. Now, broadly looking at the outlook, so 2021 is going to be a year of more caution. The pandemic has delayed the imminent recovery of the sector as a whole, but importantly, it has made people realize the homes have been the first line of defense. The market developments in the past few quarters have infused a strong hope because there has been substantial recovery in the second half of 2020, even the first quarter of this. As we said, importantly, this was driven by the low home rates, the regulatory interventions, etc. The Q1 demand had shown that Q1 numbers have shown that the demand has not eroded, but it's more deferred. Nonetheless, with the advent of this second wave, we are still cautious and watching it carefully. So this is more about the formal presentation I have, and we have got Mr. Balaji Rao also now online. And thank you for your patience. Thank you for hearing out, and we'll be happy to take any questions that you will have.
Okay, so welcome, Mr. Balaji Rao. This is Aditya. Thank you for joining in.
Thank you, Aditya. My pleasure.
Audience, if you have any questions, please quickly share. Okay, so I'm just reading out the first question. How can we use AIF for fractional ownership in real estate, or can we distribute title of the property to investor via AIF?
Good question. The problem with real estate is the title cannot be easily fractionalized. So the subdivision, having undivided shares, is not a very easy thing because it's controlled by the government through registrar's offices. So one of the ways to do this is through a fund. When the fund owns that asset, the real estate asset, be it residential or commercial, and that in turn has units against that asset, which you can then subscribe to. So it is a sort of a fractional ownership through units in a fund, which then aggregates all these units to buy that particular property. So that is the way you would be able to participate in real estate investments easily, and it has more marketability and liquidity also.
Next question. Okay, one sec. So the next question for you is, how has RERA actually formalized the sector? Are there any visible success available for us to know?
Yeah, I believe RERA will be a game changer for this segment. And that's why I call my Axis Real Estate AIF funds all as RERA opportunity funds. Because being a game changer, it will be as important to the real estate industry as when SEBI came in the early 90s, and it revolutionized the securities market. In fact, if you see the growth of the stock markets, it really was robust and grew maximum after SEBI was formed and all the rules and regulations fell into place. So RERA is going to do the same thing for us. And we are seeing the impact of it over the last 3 years itself, where the way they are being able to intervene, interject, and also help that every case doesn't need to land up in the court. It can be settled within RERA, and there is a RERA tribunal also where you can appeal against it if you want and judiciously look at what should be the right decision to be taken in any issue. So RERA will be the biggest game changer, because I think in any industry without a regulator tends to be self-regulated. And self-regulation in a very fragmented sort of an industry is not at all conducive to growth or size or scale. So it's very important that there is a regulator, and I think RERA is filling that slot perfectly to be able to protect the customer against the builder and to ensure that it is absolutely even-handed, every agreement that is there in place for any real estate transaction.
Next question. While numbers unsold are large, seemingly an opportunity, it is the profitability that is questionable. What is your views on this?
No, I absolutely agree. So the idea in this sort of a market would not be to take equity positions, because equity is the guy who's standing last, as you know. So the idea in these sort of markets is to be a structured debt. And that's exactly what the Swami Fund does also by the government, because you need to be having a lot of flexibility in what you're lending, but it need to be primarily debt and senior debt at that, because that's the only way you will be able to make money coming in last. Because yes, as the stocks are more, the markets are sluggish, the prices are under pressure, it is not going to be easy to have huge margins or make a lot of profit initially. So it's better to have a debt sort of an AIF rather than an equity AIF in real estate at this point of time.
Going to the next question. Infrastructure is a bottleneck due to space issue in metropolitan cities. Add to it the digital platform and stricter regulations. Do you see the impact on construction price and investment thereof? If so, will this be still lucrative for AIFs?
Oh, yes. See, because as far as real estate is concerned in AIFs, it is always going to be location, location, location. It still holds, that mantra still holds. So what we mean by location, location, location is basically the infrastructure which goes behind that location. There can be three types of infrastructure the way we look at it. One is the physical infrastructure, whether you have the roads, the station, the metros, everything is around or not. Other is the business infrastructure, whether it has proximity to business centers, whether it is CBD, central business districts, or suburban business districts. And third, it has the social infrastructure, whether it has the malls, the shopping, the hospitals, the schools, the colleges. So if all these infrastructure is well grounded in that location, then naturally that location is going to hold and enjoy a premium over other micro markets. So infrastructure will be the cornerstone which drives prices in the real estate market. And AIFs having exposure to such things will also necessarily have to look into the aspects of infrastructure development, both past, present, and more importantly, for a developing country like India, what is going to happen in the future.
Moving on to the next question. Is there a real estate AIF focusing on beyond top 8 cities? Your views for the growth outside top 8 cities?
See, at the moment, most funds actually focus on the top 8 cities because, truth be told, the top 8 cities control 80% of the market. So, by way of size, scale, and everything, it is in the top 8 cities, the real play is there. The tier 2 cities, I believe, will come forward more and more, especially with the connectivity. And after this COVID sort of a situation, people might prefer to go to a tier 2 city where they can enjoy a much bigger residential unit if possible. So, tier 2 cities will come into the limelight, but I don't think it will be immediate in the very short term. In the medium term, I do believe tier 2 cities will also start shining, especially those where infrastructure is being put in. So both in the north, south, east, west, you will see a lot of secondary cities or tier 2 cities as we know it also coming up, but not in the straight in the next 3 years. I believe it will be more post that.
Sure. Audience, if you have more questions, please keep sharing quickly. All right, we'll just, Mr. Raman, supporter, will just wait for a couple of minutes for the question.
Sure.
Any, okay, the next question, any thoughts on the GIFT City?
I think it's a great idea. The time has come for India to have an offshore financial center. And I think GIFT City fits into that. And because it prevents these fund managers then from having to domicile themselves in Mauritius or in Singapore or Cyprus or Netherlands or anywhere for that example. So they can be in an offshore financial center by positioning and domiciling themselves in the GIFT City. So it gives you the similar advantages. So for foreign investors to invest into India, I would believe in the future, and that's in the very near future, it would be more beneficial to them. It would be more facilitative to them to invest through an office located in the GIFT City or any offshore financial center than to be absolutely in a different jurisdiction, in a different country, and do these investments. Because as you know, there's always this sword hanging over such investments, which is called the treaty shopping. So if for whatever reason somebody believes you have used a jurisdiction only because of a tax arbitrage, it can be struck down, and there can be huge ramifications and implications on your post-tax returns. So to avoid all that, I think using an onshore financial center, which gives you the same status and benefits, is far more beneficial and far more lucrative in the long run. So I think there's a huge future and a good future for the GIFT City.
Next question, how do you think the growth of co-working space is going to be in the next 5 years in India?
Oh, I think it'll explode. Because what COVID-19 has shown is you need to have flexible working space. I don't think you will have fixed working spaces. You want to be hot desking. And more than that, you would prefer to have multiple locations. So if in most companies, when they take memberships of these co-working spaces, they automatically can go and use those facilities in the other branches of that co-working company. And that gives a huge advantage. So if somebody is sitting in Thane, for example, or in any other satellite city, it's useful for him to go to the co-working space there than to come to the central business district to the corporate office. So I feel that there will be a huge explosion in this whole co-working space because it's serviced real estate, it gives you the flexibility, and it is so much easier to manage without having to sink all your money into infrastructure. So I do tend to believe that the future will be serviced real estate. And in the serviced real estate, in the office segment, working spaces, co-working spaces will be in the vanguard.
So moving to next question. Can real estate funds also invest in international real estate?
Technically, no, at the moment, unless we create a fund and take permission for doing such things. Most people who invest in foreign real estate at the moment do so under the LRS, where you're allowed to invest in your personal capacity. So at the moment, there have not been any funds created to invest in real estate abroad completely. And even if you do, I don't know whether it would be really beneficial to us, because I think the growth and the opportunities are much more in our country at the moment as we speak than in any other foreign country, if you ask me.
Sure. Next question. There are many risks in investing in real estate, both market linked as well as risks like natural calamities and all. So how are you ensuring yourself against this on behalf of your clients?
See, the risks against natural calamities or whatever happened now, which is we're in the midst of a pandemic, these are hit across all industries, real estate notwithstanding. The risk specific to real estate is more what in terms of legal and technical risks, which we have, where you might go into some sort of a litigation. So we try to avoid such things because we have thorough due diligence being done by some top-notch service providers of this country. So they do come in, they do provide all that, and we do absolute thorough detailed due diligence. That is the big advantage of having a fund manager managing your investments vis-a-vis an individual or an institution trying to do it on its own. So that's the only way you can do it, to figure out what are the pitfalls. That way, at least you know what can be lurking around the corner. But if there is something which is an unknown, then there's really nothing you can do but to get into contingency planning and to figure out how to salvage a situation. So a pandemic like this, what we are currently seeing, or if there is a natural disaster, God forbid, I think it impacts all industries, and we have to also then depend upon contingency planning rather than really work it into the business plan as such. But if it is specific to real estate, like most of the time we have seen where people have got stuck due to litigations, then it is something, a matter of due diligence, which tries to take care to see that whatever security you're taking is of a sound title, and you have secured yourself for whatever facilities you have given to the development. And as far as the market risk is concerned, real estate's biggest advantage has always been that the demand is never destroyed. The demand gets deferred. You can delay your need for a house, but you cannot just take it away. So that is why it goes in a cyclical or a cyclical fashion, and you will always feel it coming back and forth. That means there will be spikes in demand, then there will be long periods of stagnation and softness in the market. But when the spike comes, you will be able to come out of it. So it's not something where demand just gets destroyed and disappears. So it's not a perishable commodity. So that is the big advantage of real estate. And also there's a last factor of real estate is a real asset. So the real underlying value of real estate comes from the land on which it is sitting. And land is not a depreciating asset. land always appreciates. It might appreciate slowly, it might not appreciate by leaps and bounds, but still it appreciates consistently, it will appreciate. And because of the land appreciation, real estate tends to appreciate. So when somebody says his house has become, highly appreciative over a long period of time, he's basically saying that the land in that micro market has really gone up. And that is something which is pretty natural. And as I told you, it is linked quite a bit to the infrastructure development of that place. So these factors allow you that if you plan properly, if you do your due diligence properly, then the chances of you being taken suddenly and adversely are slight.
Next question. What are the different skill sets you think are required for a real estate fund manager vis-a-vis fund managers of other asset classes?
It's a very interesting question and very close to my heart. Because see, one thing about fund managers are, at least in real estate, where we have seen a number of years, you need to be an operating fund manager. You need to really know the business. Because when you sit to negotiate, when you sit to do your due diligence, you need to be a developer yourself, literally, a quasi-developer, because you have to know the nuts and bolts of the development to understand what are the risks you're running. It's not so much of just being an Excel warrior or sitting and doing some research, market research, and understanding and saying that this is going to win the case. No, it's on the ground. So you need to know whom you're dealing with. You need to know what sort of problems you will face in doing the project. And you need to know all the other legal, technical, marketing, tax, financial aspects of the project. So it requires quite a bit of in-depth domain knowledge and operating knowledge to really jump into the sphere. And you can gain that experience slowly over the years, but it is very essential for somebody to have this, because without this, you will be blindsided. It's not a theoretical game. It's not an academic game. There's no market for it. So it's not something that I can easily dump on a stock market or something and say, fine, this stock didn't do well and this stock has done splendidly. Here in real estate, it is a real asset. So unless I know that asset inside out, and unless I know how to do a value addition to that asset, it is going to be a long haul and an uphill struggle. So yes, it requires a lot more practical and operating knowledge, in my opinion, for a real estate fund manager.
Great. Would you like to share any major hits and misses in your investing experience at Axis?
See, our experiences, to just sum up, is when you go into alternative spaces, the first thing an investor has to understand is getting into business investments. These are not savings instruments where you only look for liquidity and marketability. It's not some mutual fund or a share or a stock where if you want to liquidate it, you can liquidate it, albeit you might get a lower return or a haircut. Here, these are business investments. So when you give money for a business investment, whether it is a VC or whether it's angel or whether it's PE or AIFs or whatever it is, these require not only the fund manager to take a longer term call on that business, but one has to be patient. It is not something which will come regularly as if you're given a loan or something and the interest is going to come, coupon is going to turn up every quarter like clockwork. No, it doesn't happen that way. So you have to learn to be patient in business investments. And if you have that patience and the perseverance, then it pays off, whether it pays off after 5 years or 7 years or anything. So the problem, I think, most of us who have not matured enough to be AIF investors have been that they want to constantly see some marketability. They want to constantly know what is the NAV. They want to know what is mark to market and if they can liquidate and get out. But if that is the case, then, somebody won't be able to lend to a business, because I can't keep asking the business to whom I have lent at the whim and fancy of someone that, just give me back my money, liquidate your stock. Because these are longer term investments. These need that patience. These need that perseverance. And that's when it pays off in multiples. So I think that mindset has to be there when you come into alternatives. It's like investing in a business. You can't just ask that person every day as to now what is my value of my investment and can I pull it off. So that is something which has to be understood. And that's been one of our greatest learning, to keep on explaining to investors that, look, these are longer term investments, so please bear with us. We are monitoring it. We are doing the asset management, and finally you will be rewarded.
Sure. Next question. What do you feel will happen to so many huge tech parks or commercial real estates? Will there be a distressed market? What should be investment strategy for that?
See, truth be told, the office market is going to be a bit difficult to judge right away, because I think post COVID there would be a few adjustments. One of the things which I believe there would be a major adjustment would be that things will get decentralized. Earlier, pre-COVID, what would happen is a large IT company, support company wants to take up space. They wouldn't even mind wanting to sign up for 5 million square feet in one campus, maybe in phases, but they don't mind being in one campus in one city. I don't see that happening in the future. I think they will start decentralizing a little bit again. So this would mean that even if you do a large IT park, you'll have more clients, because you'll have to think of people taking lesser space. That's one. So this impact will be there. And also, as I was previously telling about co-working, people would want flexibility a lot more. It's not going to be something fixed. So they would want flexibility. They would want you to be more of a service real estate, where the builder or the developer puts in far more amenities, so that for a client it's easier to walk in and walk out and doesn't have to invest a lot like what we do today. Because they don't want to, I think, they will not want to sink deep roots in a way in one particular micro location, in one particular city. They would want to be fairly light footed. And so I think it needs to be seen as to how the post COVID commercial development will take place. It'll be challenging. But if you're asking me if overall there would be need for office space or there'll be growth in office space, there'll definitely be. Because Indian office space is still scratching the surface for our requirements. So there will be requirement for more and more office space. But what sort of office space will vary a lot. And that has to be carefully seen and judged, and then only developed.
Okay. So I have just received a message from some. So Mr. Rao, Sushant, do we have a few minutes? I mean, 5-10 minutes more.
Sure, sure.
So audience, one of you has messaged me that the questions are not being taken. Now I am taking the questions which I'm seeing. Fortunately, unfortunately, if I'm missing out on some questions, the reason is I'm not getting those questions. So quickly, if you want, if there's some questions that you want to ask Mr. Balaji Rao or Mr. Sushant, if you could just quickly WhatsApp it to us on this number, I will read it out for you. 8828116803. I will repeat once more. 8828116803. If you could just WhatsApp your questions on this number, it'll be easier for me to take. Because for some reason the platforms are different here, and I'm not able to see all the questions. That's what I understood from this person's remark. So please WhatsApp your questions quickly. Happy to take all questions on your behalf. We'll wait for a few minutes to see if we get any questions on WhatsApp or here, and before we wind up. I repeat the number again: 882811 6803. If you could quickly WhatsApp on this number, the team will be able to put up these questions immediately. Okay, I see one question to Mr. Rao. How do you compare the opportunity between office commercial real estate versus residential real estate in the Indian context? For someone already doing office space commercial real estate, what does residential real estate bring in a portfolio to increase in its attractiveness?
See, they both have their own significant pros and cons. Residential real estate is generally of a lower risk because it's more of a stable project, it's more secular. There's demand always for residential real estate. Commercial real estate in recent times, as I said, has taken a hit because of COVID, and there will be some sort of shuffling, reshuffling, redesigning, redevelopment, but I don't see it disappearing over the horizon. Even retail malls will come back, even hospitality will come back. They will all be there. And India being a very underserviced market, I think there will be demand for all these segments. So for an investor in real estate, he can always allocate towards both residential and commercial. Commercial nowadays, thanks to REITs, you can take a good position even with smaller amounts of money. And in residential real estate, you can either go directly in, but it will require a large ticket size, or you go in through AIF funds, which are taking a absolute exposure to residential real estate. So I think there are merits and demerits in both. And I don't think there's anything which says that you should do one at the expense of the other. We believe that in today's context, because any investment is also very cognizant of its timing and on the context, in today's time and place, we believe the residential real estate, last mile funding, structured debt are going to be the major themes and the safer themes. But it's not that in the medium to long term, commercial is not going to do well. Of course, it will do well also. So there are merits and demerits, and you have to take your decision based on the context and the timing of your market entry.
Thank you, Mr. Rao. So participants, I can't see any more questions. If you have any, quickly post here or on the WhatsApp. So let's just quickly wait for one more minute. Sorry, we are holding you back from your dinner.
No issue.
All right, I think that's about it. We've not received any other questions. So let me take this opportunity to thank you, Mr. Balaji Rao and Mr. Sushant Pote. Thank you for joining in at this late hour. It was pretty insightful, pretty fantastic. I'm sure audiences, all our audience who are watching it now and later will benefit immensely. We look forward to keep engaging with all of you on various other knowledge initiatives in the times to come. Thank you.
Thank you so much. It has been a pleasure, a privilege. Thank you so much.
Thanks a lot.
Participants, we wind up for the day. Tomorrow we start with our conference at 10 morning. So I look forward to see you all there.